Okay, good morning everyone. Welcome to Baiju's Exam Prep IAS. This is Sham Kagodia. Now, before I start the discussion, if there is no issue with the sound, please do let me know so that we can start the discussion. Give me a thumbs up. Let me know either in the form of YES, alphabet S, etc., etc. Okay, done. Let's start. So last week, what we had done, that is basically on Friday, we had made a discussion on the concept of money and banking. Correct? Money and banking. In money and banking, what we have discussed, we started with the discussion on the functions of RBI and the structure of banking sector in India. The regulator of banking sector being RBI will be at the top. Below RBI, we will have different, right? Let's say different types of banks. It could be scheduled, it could be non-scheduled, etc. After that, we started with the discussion of functions of Reserve Bank of India. Functions of a Reserve Bank. Before that, certain schedules under the RBI Act of 1934, the Central Board of Directors composition, right? Let's say the establishment of RBI, right? Initially, it was set up in Calcutta. Later, it was shifted to Mumbai. The headquarters is still there in the Mumbai. Right? These are certain basic points. After that, we started with the functions. What are the important functions? One, RBI has been given the duty of controlling inflation in India. That is, inflation has to be around 4%. Although there is a flexibility, the target is actually 4%. That is monetary policy framework agreement. After that, what is the role of RBI in printing as well as the distribution of currency in notes and coins? Right. So the Gandhi series notes, right, where they are printed, where the coins are minted, etc. We have seen that right last week. After that, the role of RBI as a banker to government, That is, RBI will facilitate government of India borrowing money. Whenever government has to pay money on behalf of government of India, the transactions are conducted by RBI, right, etc. So, role of RBI as a banker to government. There itself, we have discussed, right, the concept of open market operation, right, open market operation. Then we have discussed Operation Twist, right? What is the use of Operation Twist? Why it is conducted, right? How it is conducted, right? What is the concept related to that? After that, we have started discussing the concept of monetary policy tools, MPT, monetary policy tools. In the context of monetary policy tools, we have discussed two sets of tools. One is qualitative, second one is quantitative. The difference is very simple. In quantitative, the overall money supply will either be increased or decreased. Whereas in case of qualitative, right, in terms of qualitative, that is specific tools, we can target specific sectors. Right? We will target agriculture sector, we will target housing sector, we will target automobile sector, etc. So that is a basic idea. And under the quantitative and qualitative, different types of tools we have discussed. Please go through all of them. After that, RBI will maintain forex reserves. RBI is a custodian of forex reserves in India. RBI is a regulator of banking sector. RBI is also referred as a banker to bank, or else it is also referred as a bank of last resort. Now, one more function of RBI, that is to regulate money supply, monetary aggregate, that was left out. Last week we were supposed to discuss this slide. We'll discuss it now. Right? I hope you understand. Last week we have discussed the next slide, and that is this one. Function of RBI as a manager of forex reserves, right? Regulator of banking sector, bank of last resort, even DICGC. Right? Till this we have covered. Only one part was left out, that is monetary aggregate or money supply. Now the basic idea is there is always a demand as well as supply of money in the economy. Right? I hope you understand this. Wake up now. Please start participating. There is always a demand and supply of money in the economy. So based on the demand and supply and based on the requirement, for example, please tell me, think of it now. If the inflation is already very high, right? If the inflation is already very high, do you think RBI should increase the money supply in the economy? The answer is simply no. If the inflation is already very high, if RBI will increase money supply, then it will contribute to more inflation. But on the other side, let's imagine inflation is very stable, no risk of higher inflation. But now RBI wants to promote growth. So automatically now RBI has to increase money supply. So based on the requirements, based on the demand supply, RBI will decide whether to increase or decrease money supply in the economy. But how do we measure how much is the money supply? How do we measure how much is the total money supply in the economy? For the measurement part, for the measurement of money supply in the economy, we have aggregates called as M0, M1, M2, M3 and M4. Please remember these five, more than sufficient. M0, M1, M2, M3 and M4. Now, what is this concept of M0, M1, M2, M3 and M4? Let's start. M0 is called as high powered money. M0 is referred to as high powered money or monetary base. M0 is called as high powered money or monetary base. Now, what is this basic idea of M0, high powered money or monetary base? This basically represents, M0 simply represents what is the liability of RBI. I'll repeat the statement. M0 simply represents what is the liability of RBI, right? The liability of RBI. What do you mean by liability? Any amount that has to be returned back, that is called as liability of RBI. Now, how do we measure how much is the liability of RBI? M0 is nothing but currency in circulation plus bankers deposit as well as other deposits with RBI. Let's start. Listen carefully. Currency in circulation. What do you mean by currency in circulation? Let's imagine. Think of this. Please think of this. Let's imagine a situation. RBI will print 100 rupee currency note and will issue it in the market. Now, can I simply say this 100 rupee currency note can remain in this way? That is, out of 100 rupee, 40 rupees will be with the public, that is in the form of cash with the public, and remaining 60 rupees this person will deposit in the bank. Now please do let me know, the 100 rupee printed by RBI, given it in the market, can I divide it into two parts? 40 rupees I'll keep it with myself in the form of cash, remaining 60 rupees I'll deposit in the bank. Now if I want to calculate how much money has been printed by RBI, how many rupees have been printed as well as minted in the economy, can I get the sum total of cash with the public as well as deposits held by the bank? Can this give me currency printed by RBI? I'm going reverse, exactly reverse engineering. I will count, let's say, imagine you are the person. I will ask you how much money I've kept in the bank. You'll say, sir, I've kept 60 rupees. And I'll ask you how much cash is there in your pocket. You'll say 40 rupees. So now can I simply say 60 that you have kept in the bank plus 40 rupees that is there in your pocket is nothing but 100 rupee printed by RBI. All of you will be okay with this? I'll call this 100 rupee as currency in circulation. So how much currency is there in circulation, either in the form of deposits in the banking sector or in the form of, let's say, cash with the public, right? Cash with the public, that is called as currency in circulation. So currency in circulation plus the deposits that the banks will keep with the RBI, right? Please tell me, last week, do you remember any type of deposits that the banks will keep with RBI? Do you remember this? Cash reserve ratio, etc. So when the banks will keep deposits with RBI, don't you think the RBI has to return it back? It's a liability, right? RBI has to give it back. It is not RBI's money. So bankers' deposits as well as, let's say, central government has kept a deposit with RBI. State governments have kept with the deposits RBI. So those are deposits also are liabilities of RBI. So now please look at it. M0, which is called as high powered money or reserve money. Some of the books will also write it as a reserve money or monetary base. Basically is the sum total of how much cash is issued by RBI in the banking sector plus how much deposits the banks have kept with RBI plus how much state governments, central governments have kept a deposit with RBI. All of this is basically M0. All of this is basically called as M0. Now let me ask you a very simple question. Imagine RBI will increase M0. I repeat, imagine RBI will increase M0. Now please tell me, with increase in the M0, can money supply in the economy increase or not? Very simple question. I'll repeat it. Imagine RBI will increase M0. with change in the M0, that is, let's say increase, will the money supply in the economic change or not? Of course, yes. That is, I'll give a very simple example. Instead of 100 rupee, now imagine RBI will print 500 rupees. Instead of 100, RBI will print 500 rupees, give it to you. Now, let me take the same numbers. So instead of 100, if RBI will print 500 and give it to you, don't you think now instead of 40 rupees, you'll keep, let's say 100 rupees cash with yourself? And instead of 60 rupees, you'll keep 400 rupees deposit in the bank. This 400 rupee deposit through fractional reserve system, can it increase overall money supply in the economy? Think of it. Right? I'll repeat it. With this 400 rupees that you will keep in the banking sector, can it increase through fractional reserve system? Can it increase overall money supply in the economy? And those who are asking, sir, what is fractional reserve system? Great. You people are revising very nicely. Right? A fractional reserve system is basically a banking terminology wherein certain part of the deposit bank will keep with itself, and remaining they will use it for lending purposes. Right? We have discussed this last week. Certain part of the deposit banks will keep with themselves, and remaining they will use it for lending purposes. So the loan creation, credit creation process is done, which is nothing but commercial bank money. So overall money supply can increase or can be changed with the change in the M0. Now let me ask you second question. Let me ask you a second question. What if RBI will change CRR and SLR? What if RBI will change CRR and SLR? If RBI keeps on changing CRR and SLR, can that also have an impact on money supply? I'll repeat it. Please participate and do let me know. If RBI changes CRR and SLR, either increase or decrease, whatever it is, right, accordingly. If RBI will change CRR and SLR, don't you think automatically money supply will also keep on changing? Of course, yes. Right, this we have discussed last week also. So M0 is monetary base, high powered money or reserve money. And this represents right, basically, right, how much is the liability of RBI. Now some of you are asking, sir, how can you say money printed by RBI is a liability? How can you say money printed by RBI is a liability? I'll explain it. Although I don't expect UPSC to ask this question, please have a look at this balance sheet. Do not by heart anything in this balance sheet. Please understand my statement here. Please do not by heart anything in the balance sheet. UPSC will not ask you balance sheet. And balance sheet, again, I am concerned about some of the students in the classroom. Why? Last week we discussed concept of balance sheet. I did not discuss how balance sheet is prepared, etc., etc. That is more of a chartered accountant requirement. For UPSC, you should remember the terminology balance sheet. I told you, balance sheet represents the assets as well as the liabilities of any organization. Very simple. The assets as well as the liabilities of any organization. In a balance sheet, on the right side, we enter assets. On the left side, we enter liabilities of the organization. And by nature, please understand the statement. By nature, when you say balance sheet, both of the sides, that is the assets as well as liabilities, should be equal. All of you okay with this? Look at the terminology. We call it as a balance sheet. Means what? Whatever is on the asset side should be equal to the liability side. Now, please have a look at only one component. Beyond this, do not worry about the balance sheet here. Please look at this component on the liability side. Please look at this component on the liability side. The notes which have been printed and issued, I repeat, the notes which have been printed and issued by Reserve Bank of India. Now look at it and tell me, is it on the liability side or not? The notes which have been printed and issued, are they on the liability side or not? Of course, as they are on the liability side. Now, why does RBI keep it on the liability side? Why is it that it is kept on the liability side? Very simple. Let's start with an example. Imagine your RBI, you have printed 100 rupee note and now you want to issue it in the market. can I simply say, I will give you this G security, follow this transaction. Your RBI, you have printed 100 rupee note, you want to issue that in the market. I will give you this G security and you will give me 100 rupees cash. Now, please tell me, is this G security, when you take it, is it your asset or liability? Think of it. I'll repeat it again just to make it easier for you. I'll repeat it. Your RBI, you have printed 100 rupee currency note. You will give it to me. And in return, you will take this, right? G security. You'll take this G security. Now, will this G security become your asset or liability? This will become your asset. Some of you are very much confused. This will become your asset. This G security, you will enter it as asset for you, right? You will write it under asset. But on the other side, you have given me 100 rupee, right? There has to be an equal transaction. You'll have to enter transaction 100 rupee on both the sides. If this G security, if you write it on the side of asset, 100 rupee cash, you will have to write it on the liability side. Is it okay? Right? You will write this G security on the asset side. In fact, let me show it to you. Let me prove it to you. Please look at this. Right? Investments, domestic BD, foreign BD, bills purchased, etc., etc. All these are on the asset side. All these are on the asset side. Right? Why? These are assets for RBI, because they get returns for them. That's the reason these are written on the asset side. So very simple logic. It's a transaction. It's a very simple transaction. RBI will give cash to me and RBI will collect G security. So G security will be written on asset side. Cash issued by RBI will be written on the liability side. Okay, done. Right. So M0, currency in circulation, plus bankers' deposits and other deposits with RBI. Right, RBI. Can I go forward now? Okay, can I go forward? Now, M1, M2, M3 and M4. Some of you are worried about balance sheet details of RBI. Don't worry. I don't know why. Some of you are worried about balance sheet details of RBI. Sir, what is that? Sir, what is this? My dear, you don't have to do a detailed study of RBI balance sheet. It's not at all required. Not at all required. Okay. Now, let me start. M1, M2, M3 and M4. Understand all these components very carefully. M1 and M2 are called as narrow money. M1 and M2 are called as narrow money. M1 and M2 are called as narrow money, and M3 and M4. M3 and M4 are called as broad money. Is it okay? I'll repeat it. M1 and M2 narrow money, M3 and M4 broad money. Now, why these are called as narrow money? What is the importance of M1? Why this is called as a broad money? What is the importance of M3? Although there are four, M1, M2, M3 and M4, the most important one is M3. Most important one is M3. How you will, why you will understand in a minute. Let me start. M1 and M2 are called as narrow money because it has very high liquidity. Because it has very high liquidity, whereas M3 and M4 comparatively it is less liquid. Right? Let me explain this. Listen to me very carefully. Imagine you have 100 rupee. Example 1, you will take this 100 rupee, keep it in the form of savings bank account. And example 2, you will take this 100 rupee, keep it in the form of fixed deposit. Now, based on the discussion that we have done in the last week, can I say liquidity of example 1 will be greater than liquidity of example 2? Liquidity of example 1 will be greater than liquidity of example 2. So generally, whenever cash is held by the public, whenever people will keep the money in the form of savings bank account, will measure all of this money and will call this as narrow money. Is it okay? I'll repeat it again. Right? You will keep 100 rupee in the form of a savings bank account. You can withdraw at any point of time. Right? That is, in simple terms, demand deposits. Any point of time you demand, bank will allow you to withdraw. So because this has very high liquidity, these kind of deposits plus currency with the public, cash with the public, I'll call this as narrow money. Liquidity is very, very high. Whereas on the other side, if I count narrow money, if I take narrow money and also let's say time deposits, if I take narrow money, also take time deposits, can I say narrow money, only narrow money, when compared to this other block, that is narrow money plus time deposits, will have more liquidity? Is it okay? I'll repeat it again. Only narrow money on one side, and on the other side, narrow money plus time deposit. Can I say narrow money, the amount of money which can be called as narrow in the economy, will have more liquidity? Liquidity is a feature. Some of you are asking, what is liquidity? Liquidity is a feature of converting into money. Any asset you can convert into money, that is called as liquidity. How fast you can convert, will simply say very high liquidity. Now that is a basic classification here. M1 and M2 is called as narrow money. M3 and M4 are called as broad money. Now look at M1. Please look at M1. Out of all the money that is there in the economy, out of all the money that is there in the economy, I will take how much, right? How much currency is held by the public, how much is cash is with the public, plus I will take demand deposits in the banking sector, plus other deposits with RBI. I'll call this as narrow money. I'll simply call this as M1 type of a narrow money. Now I'll have M2 as well. What is M2? Take M1 as it is, plus add postal deposits. Add postal deposits. Now, before going forward, many of you will ask me, sir, why have you written M1 as well as M2 separately? Why postal deposits is written separately? Now, please tell me, who is involved in the creation of commercial bank money? Who is involved in lending activities in India? Is it the banking sector which is involved in the lending activities? Or is it post deposits, or let's say postal offices which are there in lending activities? Very simple question, by the way. Okay. Whether these are the banks which are there in creation of loans, or is it the post offices which are there in the creation of loans? Post offices do not create loans. Again, don't argue with me saying that, sir, post office, right? Let's say banks are there, etc., etc. We'll come to that after some time. Have patience. It is the banking sector which is there in the creation of money. So that is the reason what RBI does is they will calculate M1 without considering how much deposits you have kept in the post offices, and the other one they will count even the post office savings deposits. Can we go forward now? Is there any problem with M1 and M2? Is there any problem with M1 and M2? Both M1 and M2 are referred to as narrow money. Both are referred to as narrow money. In case of M1, we will count only the demand deposits, not the time deposits, right? Whereas in case of M2, we'll count as time deposits plus, demand deposits plus the other deposits in the banking sector plus, right, basically post office savings deposit. Now come to M3 and M4. Come to M3 and M4. Arey Baba, some of you are not listening. What is the problem? Why some of you are not listening to the class? Did I discuss earlier what is the difference between currency in circulation and currency held by public or not? Let me know. If I have not discussed, do let me know. Hardly 5 minutes ago, did I discuss the difference between currency in circulation as well as currency held by public? Then what were you listening to when I started the discussion here? What were you listening? Right, I said currency in circulation basically is printed, money printed by RBI, whereas currency held by the public, cash with the public, is basically currency held by public. Listen carefully, you people do not listen. Right, so M1, this is the formula, and M2, this is the formula. And very interestingly, some of you are asking, does M2 have very high liquidity? You tell me. Please tell me. Compared between M1 and M2, which has more liquidity? Let me know. Between M1 and M2, which has more liquidity? Do you think you keep deposits in the, let's say, post offices? You think you can withdraw at any point of time? Try it once. They will not allow you to do that. So M1 has more liquidity. I don't understand what is the problem here. All of these are straightforward concepts. Straightforward concepts. Okay. M3 and M4 broad money. M3 and M4 broad money. Now what will I do in M3? Take M1 as it is. Take M1 as it is. To the M1 you add demand deposits. I'm sorry, to the M1 you add time deposits. Within M1 already there is a demand deposit. Now to this I will add, right, a time deposits. So M1 plus time deposits is called as M3. Right? M1 plus time deposits is called as M3. And some of books, or let's say sometimes UPSC, just to confuse you, can also say which of the following components are part of M3. Which of the following components are part of M3? They'll simply write it as demand deposits plus time deposits plus other deposits with RBI, etc. Right? So this kind of question can also be asked in UPSC. Please be very careful. So to M1, I will add, right, the time deposits, that will give me M3. And finally, M4, I'll take M3, I will add, right, the post office deposits. So between all these four, that is M1, M2, M3 and M4, please listen to me carefully now. M1 has a highest liquidity. M1 has highest liquidity. M4 has a lowest liquidity. All of you okay with this? I'll repeat it. Between M1, M2, M3 and M4, M1 has a highest liquidity and M4 has a lowest liquidity. And now look at it. Can I say, for measuring how much is the overall money supply in the economy? How much is the overall money supply in the economy? Can I say M3 is a better indicator for RBI? Although M4 is there, I hope you understand, although M4 is there, but in M4 we have the post office deposits. Post offices do not create loans. It is the banking sector that will create loans. So if RBI wants to decide, should they increase money supply, should they decrease money supply, can I say M3 is the most important indicator for RBI? Can I go forward now? M3 is the most important indicator. And in fact, many of the times, RBI simply takes M3 as a money aggregate supply or money aggregate indicator in the economy, and will try to adjust that. Now, beyond this, what is the importance of all of it? What is the importance? How do you read? If you are the RBI governor, how do you understand it? Let me ask you a very simple question. Listen carefully. Okay, please listen carefully. Let me ask you a very simple question. Inflation is very high. Inflation in the economy is very, very high. You have M1 indicator, you have M3 indicator. If M1 starts increasing, I'll repeat, if M1 starts increasing at a very, very faster pace, is it a cause of concern for RBI or not? I'll repeat it, please listen carefully. Inflation is very high. You have an indicator M1 as well as M3. If M1 will start increasing at a very, very faster pace, is it a cause of concern for RBI or not? Answer is yes. It is a cause of concern. Why? Let me explain. Some of you are confused. Let me explain. Point number one, inflation is very high. Inflation is very high. That's point number one. Point number two, what is the difference between M1 and M3? Can I say, in M1 we have only the time deposits. Again, I'm talking about deposits here. Focus on the deposits. In M1, we have demand deposits, whereas in M3 we have a demand deposits as well as a time deposits. Now you please tell me, if I give you 100 rupees, can I say you'll prefer to hold it in cash, that is currency with the public, prefer to hold it in cash, or keep it in the form of savings bank account, because you know you might require it any point of time. You might have to spend it at any point of time. You might have to spend it on food. You might have to spend it on, let's say, traveling. You might have to spend it on clothing, etc., etc. But on the other side, what if you get 100, but you already have sufficient amount of money? You'll get 100 rupees, you have already sufficient amount of money, which means there is no immediate requirement of this 100 rupee. So in that context, would you not prefer to keep it in the form of time deposits? You will prefer to keep it in the form of fixed deposit for 2 years, for 5 years, maybe for 10 years, because you know you will not have any immediate requirement. You will not have any kind of immediate requirement. So now I am saying 100 rupees will come to you and you will keep it in the form of M1, which means if inflation is already high, can I say in the coming days, there will be further more demand for goods and services in the market. Is it okay? I'll repeat it again. If the inflation is very high and if M1 starts increasing at a very faster pace, can I say this is an indicator of further higher demand very soon, maybe after 1 week, maybe after 1 month. So now should RBI increase money supply? Tell me now, in this situation, should RBI reduce the CRR? Should RBI reduce SLR? Should RBI reduce the repo rate? Answer is no. RBI should not reduce any one of them. Why? Because the indicator is inflation is already high. M1 is also increasing. In fact, RBI should start right increasing CRR, SLR, repo rate, etc. Because now there is a danger that if RBI doesn't do it today, maybe in the future, after a couple of days, demand will start increasing. Right? Even if the inflation is moderate, some will say, sir, but inflation is already very high. RBI should do it. Let's say inflation is moderate. Let's say inflation is 4%. And M1 is increasing at a very faster pace. Is it okay? Inflation is, let's say, 4%. M1 is increasing at a very faster pace. Does it not mean even in that context, in the next couple of months, inflation could start increasing? Is it okay? I'll repeat the statement, understand these statements. I'm saying inflation is moderate, let's say 4%. But M1 is increasing at a very high pace. Is it not an indicator that in the next couple of weeks or next couple of months, there might be higher demand which will pull up the inflation in the market? Of course, the answer is yes. Right? So that is how RBI generally uses these kind of indicators to decide whether they should increase repo, should they increase CRR, should they increase SLR, etc. Right? All of you okay with how do you understand these indicators? Anybody has a problem? Can we go forward now? Right? Related to this, sir, couldn't understand why post office deposits are added separately. Because I'll repeat it again. Whenever you talk about post offices, post offices do not create loans. Post offices do not create loans. Again, same answer to another student who is asking, sir, why are we using M3? Why not M4? My dear, difference between M3 and M4 is post office deposits. In M4, post office deposits are counted. In M3, post office deposits are excluded. I'll repeat it again. Post offices do not create loans. Post offices don't give you loans. Whereas in terms of demand and supply of money in the economy, generally banking sector creates loans. Is it okay? Banking sector creates loans. That is the reason RBI to decide should they increase money supply, should they decrease money supply, they will take the components where banking sector is present. That would be M3. M3 would be more appropriate for you. Okay? Done? Can we go forward now? In addition to all of this, there is one more component called as money multiplier. There is one more component called as money multiplier. Now, what is this concept of money multiplier? Money multiplier simply represents what could be, right? What could be the increase in the money supply to maximum extent, how much money supply can change with the change in the reserve money. I'll repeat the statement, listen to me carefully. Money multiplier simply measures what is the maximum change that is possible in the overall money supply when you change reserve money in the economy. That is, if you simply change M0, to what extent M3 will get affected? To what extent M3 will get affected? That is called as money multiplier. It is called as money multiplier. How do we measure money multiplier? The formula for money multiplier, MM, the formula for money multiplier is equal to M3 upon M0. M3 upon M0, right? I'll repeat it again. Please listen carefully. What is the money multiplier? What is the maximum change in the overall money supply when you change the reserve money? When you change the reserve money, that is called as a money multiplier. That is, let's say hypothetically, the overall money supply M3 will change by 500 or will change to 500 rupees. If M0 is 100 rupees, can I say money multiplier is 5 times? I'll repeat it again. The broad money supply measurement that is used by RBI is M3. Imagine 100 rupees printed by RBI. So some of you will start asking, how can you get M3 500? If RBI will print 100 rupees, if RBI will print 100 rupees, issue it in the market, let's say hypothetically, out of that 30 rupees will be cash held by the public, 30 rupees will be cash held by public. I'm just giving a hypothetical example here. The time deposits created in the banking sector will become, let's say, 250 rupees. The demand deposits will become 220 rupees. Please tell me, can I say in this example, the M3 will be 500 rupees? Let me know. M3 will be 500 rupees. Anybody has a difficulty? Please do let me know. Right side, this table I'm asking, this box I'm asking. Imagine RBI will print 100 rupee and give it to you. You will keep 30 rupees in the form of cash with yourself. Remaining, you will keep in the form of deposits in the banking sector. Again, the bank will use the deposit, give loans. Again, the money will come back to the banking sector in the form of deposits. Again, they will give loans. So I'm assuming as a result of this, time deposits will be 250 rupees, demand deposits will become totally 220, which means M3 will become 500 rupees. So if I substitute it, right, I'll simply get it as 5 times. So what does it mean? The total amount of money supply in the economy will change by 500 if RBI will change the money supply, right, that is reserve money, by 100 rupees. Yes or no? Anybody has difficulty? I'll repeat it. If RBI will change its monetary base by 100 rupees, overall money supply will change by 500 rupees. Now, RBI can change it either ways. It can increase or it can even decrease. But basic argument is for every 1 rupee change in the monetary base, the overall money supply will change by 5 rupees. That is the indication. That is basically the money multiplier. Arey Baba. Some of you are not revising. I don't know why. Some of you are asking, how can you get 250 rupees? How can you get 220 rupees with only 100 rupee? My dear, do remember this fractional reserve system. And you people are not revising. That becomes a problem now. You people are not revising at all. Please tell me, in this example, look at this table. In this example, how much money has been printed by RBI? Let me say how many if you are revising, how many if you are not revising. In this example, how much money has been printed by RBI? Can I say RBI has printed only 100 rupee? First step number 1. RBI has printed 100 rupee only. But because RBI has printed 100 rupee and supplied it in the economy, I'll take only 2 steps now. Please tell me how much loans have been created by the banks here. How much deposits have been collected by the banks here. How much loans have been created, how much deposits have been created. So all of you okay with this? I'm just telling you this. Listen to me. All of you okay with this? That is, if RBI will print 100 rupee, the total deposits collected in the banking sector obviously has to be more than 100. Yes or no? Even now, anybody has difficulty? If RBI will print 100 rupee and give it to you, because of fractional reserve system, the loans created will be more than 100. The deposits collected will be more than 100 because of fractional reserve system. Right? I'll give a very simple example. I have got 100 rupee. I will deposit 100 rupee with you. You are a bank. You will use that 100 rupee, give it as a loan to somebody else. They will purchase something. Again, the money will come back to the bank in the form of deposit. That's a basic idea. Right? So if RBI will print 100 rupee because of fractional reserve system, the money supply will be more than that. And I'm counting deposits in the banking sector. How much money is there with the public, cash held by the public, or else they will deposit in the banking sector. All of you okay with this? I'll repeat it. Either you will have cash or you will keep it in the bank, right? So I will count cash with you plus deposits in the banking sector. That will give me, right, the total money supply in the economy. Total money supply in the economy. So if total money supply in the economy is 500 and RBI had changed it monetary base by 100 rupees, then I'll simply say money multiplier will be 5 times. Now, rather than this, can the money multiplier, again, one more hypothetical example. Can I say money multiplier can also be like this, M3 upon M0, where it is 2000 rupee divided by 500 rupee, where money multiplier will be 4 times. Is it possible? Let me know. Possible or not? Of course, yes. That is also possible. Right. So money multiplier basically means what can be the maximum change in the total money supply in the economy whenever the monetary base of RBI, reserve money of RBI will change. That measurement is called as money multiplier. Can I go forward now? Can I go forward? Now, please think of it. I'll give a very simple situation. Please think of it. If money multiplier is very high, and if there is a danger of higher inflation, then can I simply say RBI should not reduce CRR by a large percentage? Let me know. I'll repeat the statement. If money multiplier is very high, let's say 7 times, 8 times, and if there is a danger of inflation, if RBI will reduce the CRR by 2%, 3%, SLR by 4%, 5%, don't you think overall money supply will suddenly increase by a huge number? Right? Why? Look at the money multiplier. If it is 7 times, if RBI will reduce CRR by, let's say, 1%, and as a result of this, 100 rupee will enter into the system, having a money multiplier of 8 times simply means that will become 800 rupees. That will simply increase the money supply by 800 rupees. So that is the reason, right? If question is asked, if there is right, let's say a scope of high inflation, RBI, right, should increase the CRR, should decrease the CRR when the money multiplier is so high. Please think accordingly. Okay, can I go forward now? Anybody has any issue, please do let me know. Can I go forward? So this is the discussion regarding Reserve Bank of India. I've discussed regarding Reserve Bank of India. Going forward, here and there, wherever it is required, again we will add RBI. But I'm pretty sure we have covered most important concepts related to RBI, which are needed for UPSC exams, which are required for UPSC exams. I believe we have spent around 3 to 4 hours only on Reserve Bank of India. So it's very important. Please be very careful. Now let me go to the next one. Nationalization of the banking sector. How does nationalization was conducted? How was it conducted? What is the importance of it? Right, and what is the issue related to this? The first round of nationalization was conducted in 1970. Second round of nationalization was conducted in 1980. After that, we have not gone for any nationalization. What do you mean by nationalization? Government will take away the ownership. Very simple. Government will take away the ownership. Right? Government will basically give money to you. If you are the owner of the bank, will take away the ownership from you. That is called as nationalization. So the first round of nationalization was conducted in 1970, 14 banks. Second round was conducted in 1980, 6 banks. So 2 rounds. After that, we have not gone for nationalization. Today, if you are reading newspapers, today government is not considering any kind of nationalization in the banking sector. In fact, the government is actually merging the banks now. Correct? Government of India is actually merging banks. For example, have you heard of newspaper article, or let's say, have you heard of this generally, where Government of India merged the SBI with other associate banks? Right? SBI, there were associate banks. For example, State Bank of Mysore, State Bank of Patiala, State Bank of Travancore, etc. These associate banks were merged with State Bank of India to make a very, very large bank, very, very big bank. So today government is not thinking of nationalization. In fact, government is thinking of consolidation, merger of the public sector banks. Now, why it was done? Why did we go for two rounds of nationalization earlier? Why did we stop? Earlier, please understand, situation of Indian economy was completely different. For example, large population was involved in agriculture sector, and this population was finding it very difficult to access institutional credit, to get institutional loans. And whenever you come across the term institutional loans, it simply means loans, credit from banking sector, credit from NBFCs, etc. So whenever you take loans from organizations, institutions, companies, these are called as institutional loans. And for farming sector, for agriculture sector, whenever they take institutional loans, especially from banking sector, they prefer it. Reason being, interest rates are comparatively very low. Interest rates are comparatively very low, right? Just to prove the point, let me give you one example. As RBI report suggests, there is one RBI report which says that if a farmer will take a loan from a bank, average rate of interest on agriculture loan is somewhere around 7 to 9%. Average rate of interest is somewhere around 7 to 9%. If the farmer will take a loan from money lender, informal money lender, the average rate of interest is 24% to 36%. Average rate of interest is in the range of 24 to 36%. So it's a no-brainer. If you are a farmer, if I'm a farmer, I would prefer to take loan from the banking sector and not from informal sector. It's very logical. I would prefer to take a loan from a banking sector, not from informal sector. So earlier, the situation was that the farmers were finding it very difficult to get access to agriculture loans because these were privately owned banks. Privately owned banks. So government of India decided, let me nationalize them, let me bring them under my control so that weaker sections of the society, agriculture sector, poor people will find it very easier to get loans. So one, basically to provide institutional credit and to ensure that needy people, farmers, poor people, etc., will get access to the loans from the banking sector. Third point was the banks which are privately owned were focused on the profits. They were targeting profits, and because they were targeting profits, most of their branches or their concentration was on bigger cities. They focused on very, very large cities for establishing the branches, right? And this led to lower penetration of banking sector. Low number of branches were opened in regions or rural areas. Now RBI said, or even government of India said, right, we will not allow this to happen. We want more and more branches to be set up in villages. And one way that we ensure that the banks will go to rural parts was to go for nationalization. In fact, please remember this. Even today, RBI has a branch licensing policy. Even today, RBI has a branch licensing policy. What do you mean by branch licensing? In 1 year, imagine you want to open 100 branches. RBI will mandate that at least a certain number of branches should be opened in villages, in smaller cities as well as villages, to ensure that credit penetration or banking penetration will also take place in small villages, small cities, etc. So concentration in urban areas, that was one more issue. And the banks were owned by rich businessmen. The banks were owned by rich people, and they were finding it very easy to get loans, and others were finding it very difficult to get loans. So these are some of the reasons which was cited by government of India to go for nationalization. First round took place in 1970. Now, before I go forward, some of the books have written this as 1969. Some of the books will write it as 1969, right? Whether 1969 is correct or 1970 is correct. Please understand this. The government proposed it in 1969, implemented it in 1969. Government was attracted to Supreme Court of India. Compensation part. Government was attracted to, right, Supreme Court of India. Supreme Court of India struck down the nationalization. Is it okay? Supreme Court of India struck down the nationalization. And that is the precise reason. Again in 1970, Again in 1970, Government of India came out with the policy of nationalization, and this was implemented. All of you okay? Those who are right telling me, sir, right, it is different in the book, it is different in this website, but you are saying something else. 1969 proposal was done and implemented, but it was taken to Supreme Court of India. Supreme Court of India stuck down the process of nationalization, and again in 1970, Government of India had to implement it. That's a basic idea. Why there is a difference between what is given in the book and what I've written in the slide. So first round of nationalization, second round of nationalization. After this, we have not gone for nationalization. That is post 1991. In fact, for post 1991, Government of India has not gone for nationalization. Right? In many of the sectors, we have gone for privatization. At post 1991, you will not see government opting for nationalization, not just in banking sector, but in many sectors. Instead of nationalization, we have adopted the concept of privatization now. Again, we'll discuss that as a concept of disinvestment, a divestment, etc., when we take up industries. But just to give you a glimpse of it, can I say you're seeing more and more privatization of many of the companies owned by Government of India in recent times, let's say in the last 7 to 8 years or even before that. Best example is Air India. Best example is Air India. Again, why does government do it? Is there any problem with idea for privatization, right, etc., etc.? We'll discuss that later, not today. We'll discuss it later. I'm not saying we'll not discuss it, but there is a discussion on that under the concept of disinvestment when I'll take it up under industries. Don't worry. So this is regarding nationalization. Now I said government now, instead of going for nationalization, is going for mergers. Instead of nationalization, is going for mergers. Why? What is the argument? Why is government creating very large banks? Right? What is the objective behind it? Let's try and understand. In recent times, Government of India started merging public sector banks. Earlier, the number of public sector banks was somewhere around 20. Today, it has become almost half of it. It is somewhere around 10, and it will keep on reducing. Don't worry, it will keep on reducing. The reason being, Government of India now says, rather than having multiple public sector banks, we will have less number of public sector banks, but the size of the public sector banks will be very, very large. Meaning what? Let me give a very simple example. Imagine there is one public sector bank A, another B, and another C. And let's say hypothetically, A has assets of 100 crore rupees, B has assets of 200 crore rupees, and C has assets of 70 crore rupees. Smaller banks. Now, rather than having three banks of smaller asset size, if I merge all the three banks with the asset size of 370 crore rupees, don't you think this is one bank? Number of banks with government has reduced, but the size of the bank has increased. I'll repeat it. Number of PSBs with the government has reduced, but the size of the bank has increased. And what is the advantage of all of it? Advantage is one. Can these banks start competing with international banks now? Right? Please think of it and let me know whether this makes sense or not. Can these banks start competing with international banks? Of course, yes. Rather than having only the domestic presence, they can enter into even the foreign market, start competing in the international market. Second, larger the banks, larger will be the asset size. Can they start providing larger loans to certain sectors? Larger becomes the asset size, can they start providing larger loans to certain sectors? Right? What is the meaning of it? Let me add a particular point here. Infrastructure. Right? Infrastructure. Sir, any example of infrastructure? Roads, tunnel, right? Railways, ports, airports. These are examples of infrastructure. Always remember this. For development of infrastructure, you need large loan for longer period. I will repeat the statement. For development of infrastructure, you need large loan for longer duration. For example, you want to construct a national highway 1000 kilometers. You want to take a loan from a bank. Will you apply for 50 lakh rupee loan? Will you apply for 1 crore rupee loan? You can apply, but will you be able to construct the road project? It will not be possible. You want to construct an airport? Will you apply for a loan of 80 lakh rupees? Not at all possible. Not at all possible. You need large value loans, 100 crores, 150 crores, 80 crores, large value loans. In fact, in many of the projects, they will take 5,000 crore rupee, rather 6,000 crore rupee, 2,000 crore rupee loans, large value loans. Point number one. Point number two, you need to take a loan for longer duration, not for short duration, longer duration. Why? Imagine you want to construct an airport. You want to construct an airport. Today you will take a loan. Is it possible for you to start repaying the loan after 1 month, after 2 months, after 3 months, and you will close the loan within 1 year? No, it will take multiple years for you to just finish the project. Yes or no? It will take a long period of time for you to finish the project, then start generating revenues. And you will use the revenues to repay the existing loans. So you want to take a loan which is given for you for a longer duration. Remember that. Now, what is the importance of it? Listen to me carefully. Generally, in case of India, banks suffer from an issue called as asset liability mismatch. Generally, in case of India, banks suffer from an issue called as asset liability mismatch. Now, what is this concept of asset liability mismatch? Let me explain. For a bank, I will write asset on one side and I will write liability on the other side. And commerce students will be very happy. I'm following the process here. Asset on the right side, liability always on the left side. Now, let me start with an example here. A bank will collect a deposit from the customer, maybe for 1 year, maybe for 6 months, maybe for 2 weeks, let's say 100 rupees. I'm simplifying it. Listen to me carefully. The bank will collect a deposit from a customer. Either it could be a time deposit or demand deposit. So generally, can I say it can be 3 months, 6 months, or even a few days, 2 weeks, etc. So let's say they will collect a deposit of 100 rupees, which is there for 1 year. Fixed deposit, let's say 1 year. If there is no reserve requirement, assume if there is no reserve requirement, bank will take 100 rupees, give it as a loan to a company for 15 years. For 15 years. Now, please tell me, is there a difference between the duration of asset as well as the duration of liability? Look at the example and do let me know. Is there a difference between duration of the asset and duration of liability? Of course, yes. The asset has the duration of 15 years and the liability has a duration of only 1 year. This is called as asset liability mismatch. This is called as asset liability mismatch. Banking sector suffers because of this. And smaller the bank, more will be the impact of asset liability mismatch. Now let me explain what is the problem with this. If they have an asset liability mismatch, what is the problem with this? Problem is, imagine the bank is very large, very large, and it has huge amount of deposits. It has collected huge amount of deposits. The customer base for the bank is very high. So the collection of deposits will be very high. The reserves held by the bank will also be very high. So now can I simply say, even if the customers want to withdraw, some of the customers want to withdraw the money, reserves will provide cushion to the bank. Correct or not? I'll repeat it again. Right? The bank has a huge depositor base, very large depositor base. So even if few of the customers will go to the bank, there is a asset liability mismatch, no doubt. Even if some of the deposits will go to the bank has a huge customer base, means huge reserves also. So can I say reserves can be utilized by the bank to facilitate withdrawal of the money from the depositors. But apart from that, there is one problem regarding the liability mismatch or asset liability mismatch, that is called as interest risk. This is basically nothing but interest risk. What is this interest risk? Let me explain it. Listen to me carefully. Imagine I'm a bank manager. I've collected 100 rupee from you, and the interest rate right now is 4%. I'm giving you an interest of 4%. Let's say fixed deposit. Next year, you will come to me. You want to withdraw this 100 rupee. I don't have large deposits with me. I cannot allow you to withdraw because I don't have money. So, what I will do now, I will collect 100 rupee deposit from one more customer today because you want to withdraw it today. I'll collect this for the 100 rupee deposit from one more customer, fixed deposit. But what if interest rate after 1 year is 5%? Interest rate after 1 year is 5%. So now can I simply say, for the bank, I repeat, for the bank, because of variation in the interest rate, same 100 rupee, now I will have to pay 1% additional interest rate. Please think of it. I'll repeat it again. Right? Today I collected 100 rupee from you. I gave you 4% interest rate. You kept an FD of 1 year. After 1 year, you will come to me and you want to withdraw that 100 rupee. I will take one more deposit from the customer and give you this 100 rupee. But after 1 year, FD rate has become 5%. So can I simply say, for the same 100 rupee in a span of 1 year, in a matter of 1 year, I'm paying 1% extra interest rate. This is happening because my liabilities are of a short duration. Rather than short duration, what if even the liability was of having a duration of 5 years, duration of 8 years, duration of 10 years? Don't you think this interest rate risk that I will be facing will be minimized because of it? Anybody has a problem with this? Please do let me know. Anybody has a problem with this? I'll go forward. Right? So basically, the banks suffer because of asset liability mismatch. That is the point. Banks will suffer because of asset liability mismatch. And in case of India, lot of banks do suffer because of asset liability mismatch, because their asset sizes are very, very small. How decrease with longer time, sir? My dear, instead of coming back to me to withdraw after 1 year, if you keep a deposit of 10 year, right, don't you think I'll keep on giving you 4% interest rate only? I don't have to collect deposit again in the market like this. How many of you know how fixed deposits actually work? Let me see. How many of you know fixed deposits actually work? Let me see how many of you know. If you keep a fixed deposit of 10 years, do you think the bank will keep on changing interest rate every month on the fixed deposit? Let me know. If you keep a FD of 10 years, do you think the bank will keep on adjusting your fixed deposit interest rate every month or every year like this? No, they will not do that. Whatever was the initial interest rate, they'll keep on paying that only. And here is a hint. That is, if any of you have a fixed deposit, do not allow the banks to keep, right, to basically fix the deposit again once the maturity is over. That is, whenever you keep a fixed deposit, the bank will ask you one option. Once the maturity period is over, do you want me to renew the FD? Check it. The bank will ask you, one of the option will be, once the FD maturity period is over, do you want me to renew the FD? If you say renew FD, gone. Most of you will be losing a lot of interest rate. Why? Renewal is done at the same interest rate. But if you have seen the economy today, in the last 1.5 years, FD interest rates have increased. So you might be losing some of the interest on your FD if you are opted for auto renewal. Please be very careful. Again, UPSC will not ask you this, don't worry. So come back to the discussion here. Argument is simple. If you make the banks much larger by merging them, they will have large asset base. And because they will have large asset base, they can give longer loans. They can give larger loans. So they can compete with international banks. And tell me now, if you merge the banks, can I say the human resources requirement will be reduced? Correct? Human resources requirement will be reduced. The rental space requirement will be reduced. Right? So obviously the cost of operations can be, right, made much more efficient. It can be made much more efficient because you're merging the banks. Rather than having 5 branches, now they will end up having 2 branches in one area. They might open 2 more branches in other cities. So reach of the banks might increase, operation cost will reduce. Right? All these are advantages of having merger of banks into larger bank. So have a look at it. Cost of operations will come down. Reach of the banking sector, right, will increase. Resources, human resources, technological resources, right, the money resources, etc., can be pooled, can lend for various sectors, and can compete with various other foreign banks as well. Can we go forward now? Anybody has an issue with the advantages or the pros of large banks in India? Please do let me know. Next one, cons. If you create larger banks, what is the problem with that then? What is the issue with that? First one, right? Imagine 3 banks are there, ABC, 100 crore, 200 crore, 70 crore. You have merged it to create a very large bank, let's say D, 370 crore. Now, please tell me, what would you prefer? What would you prefer, or what is less damaging? One bank with asset size of 370 crore falling, failing, or one bank with only 70 crore asset failing? Would you prefer a smaller bank failure, or would you prefer failure of a larger bank? Right? Just to give you one example, every now and then in the newspaper you will be reading some of the cooperative banks are failing, some of the regional rural banks are failing. No worries, it's a problem, it's a concern, right? But imagine, compared to that, let's say you will open Hindu newspaper today and the first article is State Bank of India is failing. So can you imagine it? Right? Can you imagine it? State Bank of India failing, a large bank failing. So I hope you understand. If the banks are very large, impact of the failure will also be very huge. Right? So earlier we had smaller banks. Now you're merging them to create a very large bank. If this large bank fails, impact will be very, very high. It's a biggest concern. It's a very, very big concern. That is the first point. Second point, if mergers will happen, automatically we would not require same number of employees. Then what will happen to number of employees? Can there be a situation where some of the employees will be removed from the banking sector? Of course, yes. Some of the people will end up losing jobs. That is a concern. Right? Labor requirement will be affected. Right? Employees would be affected. That is a cause of concern. Third one, what about working culture? Will there be a change in the work culture? Will there be a change in the timings? Will there be a change in my position, in the sense, let's say I'm working only in one state? Can I be shifted to another state now? Can I be shifted to, right, another district because the banks are getting merged like this, etc. So work culture, right? Let's say the security of the job, salary payment, etc. It's a cause of a concern regarding the mergers. Can we go forward now? All of you okay with this? Anybody has a problem, please do let me know. So the advantages as well as the concerns, both are there. But Government of India has been merging public sector banks. In India, please remember this. Government of India has been merging public sector banks. For example, I gave you one earlier. 5 associate banks were merged with SBI. Today, there is no Bank of Mysore. There is no Bank of Patiala, right? State Bank of Mysore, State Bank of Patiala, State Bank of Travancore, State Bank of Bikaner and Jaipur, State Bank of Hyderabad. These are not there today. They have been merged with State Bank of India. That is basically one example. Another one, there was one more bank which was established by previous government, Bharatiya Mahila Bank, BMB, Bharatiya Mahila Bank. It was established as an, right, all women run bank, right? So that was also merged into SBI. And one more example, the Bank of Baroda, right? Bank of Baroda, we have taken Bank of Vijaya Bank, we have merged it to Bank of Baroda. And so there have been multiple examples in recent times where Government of India is merging public sector banks to create a larger bank. Okay, done. So pros as well as cons. Please tell cost of operation decrease, but it will lead to shutting of banks, but it will decrease reach. My dear, listen to me very carefully. Earlier, let me take an example. Let me know whether this is correct. Have you observed it or not? Earlier, if you have seen, imagine this is a street in a city, particular street in a city. You'll see State Bank of India branch. And opposite to that, you'll also see State Bank of Patiala branch. And after certain shops, you will see State Bank of Mysore. And this side, you might also see State Bank of Bikaner and Jaipur. Have you seen this kind of incidents earlier? Let me know, have you earlier seen this or not? Where in the same lane, multiple branches of State Bank only are present. Now, if all these banks are merged only into SBI, can I say real estate requirement, labor requirement, right? Let's say technological computer requirement, electricity bill, etc. will come down because only one branch will be there. All of these customers will get shifted only to one branch. So real estate requirement, right? Salary expenses, the electricity bills, etc. All of them will come down. Cost of operations will come down. Rather than having 4 branches in only one area, can I open, right? Shut down these 3 and can I open one branch in a village now? Can I open one branch in another city or another district, another taluka where the reach was not earlier very high? Obviously, yes. So reach on one side will increase because we are consolidating the banking, let's say, branches. We are consolidating them, right? We are making the system much more efficient. Okay, right? So these are some of the things associated with the idea of a larger bank. Now, regarding one point, please understand this. There is one point here. Higher size means impact of failure will also be very, very high. It is a cause of concern. So, has RBI taken any measure to address it? It's a cause of concern. You create a larger bank. What if this large bank will fail? Has RBI taken any measure to address it? Answer is yes. There is a policy of RBI called as a too big to fail banks. Remember this? There is a policy of RBI called as too big to fail banks. Too big to fail banks. Every now and then, RBI will keep on adding banks into too big to fail banks. For example, SBI is a too big to fail bank. HDFC is a too big to fail bank. Right? Argument of RBI is, if you're very large, if your size is very, very big, generally more than 2% of GDP, then you will be classified as a too big to fail bank. And once you're classified as a too big to fail bank, again, when I say too big to fail, RBI has a system called as a domestic DSIB, domestic systemically important bank. Right? A DSIB means a domestic systemically important bank. Right? It's a very large bank, too big to fail. That is basically DSIB. RBI says if you're a very large bank, I will not allow you to fail, in the sense the kind of conditions I will have on these banks, the regulations I will have on these banks will be much more strict. The regulations that RBI will impose on these DSIBs will be much more stringent. Very, very strict regulations will be imposed. That concept is called as a DSIB, domestic systemically important bank. Okay, done. Now let me go to the next point. Lending rate regime. Concept of lending rate regime. Now, what is this idea of a lending rate regime? Let me explain. Listen to me very carefully. Okay, listen to me very carefully. Now, what is this lending rate? Whenever you come across the term lending rate in the context of a bank, the bank will collect money, bank will collect deposits from different sources and will give loan to customer. Will give loan to a customer. So whenever bank will give loan, what is the rate of interest charged? What is rate of interest charge? That is nothing but lending rate. Is it okay? I'll repeat it again. Imagine you're a bank. You will collect money from different sources. For example, can I say bank can collect money from Reserve Bank of India? Collect money in the sense, borrow money from Reserve Bank of India. The bank can borrow money from individual depositors such as you and me. The bank will collect money or borrow from even corporates. Companies will keep, let's say, savings bank account, the current account. Generally, companies will have current account. So companies will keep current account deposits. Companies will keep fixed deposits in the banking sector. So bank can borrow from different sources and will lend to the borrowers in the market. So when the bank will lend, it will charge a rate of interest that is called as lending rate. Now, point number one, how does bank decide a lending rate? Listen carefully. Can I say one of the most important factors that will determine the lending rate will be what is the rate of interest bank will pay when they will borrow. What is the rate of interest that the bank will pay when they will borrow money? For example, let me know. Can I say if a bank will borrow from RBI, it will pay repo rate of interest or bank rate? Anybody has a problem? If a bank will borrow from RBI, it will pay either repo rate of interest or bank rate. All of you okay? Now always remember this. The interest rate, I repeat, the interest rate that the bank will pay is called as cost of funds. I will repeat the statement. The interest rate the bank will pay, will call it as cost of funds. So now bank will borrow from customer, pay rate of interest. Bank will borrow from companies, pay rate of interest. Bank will borrow from RBI, pay rate of interest. So please do let me know. The first and in fact the most important factor that will lead to decision on the lending rate, can I say cost of funds? Is it okay? The most important factor that will determine what is the lending rate is nothing but cost of funds. Second one, cost of CRR. Let me see how many of you remember. Cost of CRR or negative carry on CRR. Should this be included or not? Please think and do let me know. Cost of CRR or negative carry on the CRR. If a bank is lending money, should they include that also, right, in deciding the lending rate? Of course, yes, they should include that also. What about cost of operations? What about cost of operations? Right, electricity bill, right, internet bill, right, the salaries or wages paid to the employees, the rent that they have to pay for the bank premises, all of that cost of operations, that is also very, very important. Fourth one, profits. Correct? Profit motive. One bank would want to earn 1% on 100 rupee loan they are giving in the form of profit. One bank would want to earn, let's say, 2% profit if they give you 100 rupee loan. So profits should also be included. Right? So these are some of the important parameters. I repeat, these are some of the important parameters. And in fact, please remember this. Even after including all these parameters, can I say, whenever banks will give loans, different borrowers, they will charge a different rate of interest. I'll repeat the statement. Let's say hypothetically, you are a bank, you will calculate for all of it. Should you provide all the loans at 8% rate of interest? Does it make sense to you? Think of it. Should you provide all the loans at 8% rate of interest? No, you should not provide it. Why? What is the tenure of the loan? What is the tenure of the loan? That is, what is the duration of the loan? That will also determine what is the rate of interest you are going to charge. Whether the borrower is giving security or not, whether the borrower is giving you any security or not, that will also have an impact on at the rate of interest. For example, what I mean by this, imagine there are two borrowers, okay, customer 1, customer 2. There are two borrowers who are taking a loan. Customer 1 doesn't provide any collateral. Customer 2 provides a collateral or security. Should you charge same rate of interest for both of them? Of course, no. You might be giving 100 rupees to both of them. You might be giving 100 rupee loan to both of them, but because you are getting a security from the second customer, obviously because of security, you will charge a comparatively lesser rate of interest here. So now all of you okay with these terminologies? Anybody has a problem, please do let me know. Right? Whenever banks will decide their lending rate, what are the factors? What parameters will they consider in deciding the lending rate? What is the tenure of the loan, right? What is the duration of the loan? Whether the customer is giving any kind of security or not? What is my cost of funds? What is my cost of CRR? What is my operational expenses? What is my profit motive? These are generally the parameters which are considered by the banks whenever they will provide a loan and they want to charge a rate of interest on it. Now, what is the importance of all of it? What is the importance? Listen to me very carefully. There is a term called as monetary policy transmission. There is a term called as monetary policy transmission. MPT, monetary policy transmission. Now, what is this monetary policy transmission? Let me give you one example. Imagine example one. Imagine RBI has reduced, right? Let's say repo rate. Imagine RBI has reduced repo rate by 2%. RBI has reduced repo rate by 2%. As a result of it, as a result of this, the lending activity of the banks, that is loans given by the banks have increased by, let's say, I'll take a simple number, by 2000 crore rupees. Loans given by the banks have increased by 2000 crore rupees. Example 2, RBI has reduced repo rate. Same, RBI has reduced repo rate by 2%, but the loans issued by the banks, new loans issued by the banks, have increased only by 500 crore rupees. Now, can I say based on this, can I simply say the efficiency of monetary policy, right? The transmission means transfer. The transmission of monetary policy is more effective in example 1 compared to example 2. I'll repeat the statement. Listen to me carefully. The transmission means effectiveness, right? The transfer of the benefit. The transmission of monetary policy changes is more effective in example 1 compared to example 2. Anybody has a difficulty in understanding the statement? Let me know right now. Right? The RBI has changed repo rate. It has reduced repo rate. With reduced repo rate, you expect automatically banks will also reduce their lending rate. And if banks will reduce their lending rate, the loans issued in the banking sector should automatically start increasing. But you're seeing in example 1, loans are increasing by a larger number compared to example 2. And some of you will ask me, sir, why? Why is it happening? If RBI reduces repo rate by 2%, should the banks not reduce the lending rate by the same percentage? Not necessarily. What if I say RBI will reduce repo rate by 2%, and in example 1, banks are reducing their interest rate on new loans by, let's say, 1.8%. Banks are reducing the rate of interest on the new loans by 1.8%. In second example, they're reducing the rate of interest on the new loans, but by only 0.5%. So don't you think automatically, because the reduction in the first example on the new loans is much bigger, the new loans issued by the banking sector will also be much larger? So that is the idea. That is the argument. If anybody has a problem, let me know. Please participate. These are technical concepts, I know, but once you understand, it becomes very simple. It should make sense to you. So in the example 1, I'll say monetary policy is much more efficient compared to example 2. Can I go forward now? When you say not understanding, what is the point you're not understanding? When you say you're not understanding, it's very difficult. What is the point? You will have to tell me that. If you say simply not understanding, I cannot repeat whole banking now. Okay, I'll repeat it again. RBI will reduce repo rate by 2%. Tell me now, RBI will reduce repo rate by 2%. What is the effect you expect to happen in the market? Let's start with the basics. If RBI will reduce repo rate by 2%, the impact will be loans issued should be more. Simple. Impact should be loans issued should be more. Now I'm taking two examples. In example 1, imagine again, please, again, don't ask me when RBI has reduced by 2%, why it is reducing by 2%, that is not the point. Imagine RBI has reduced repo rate by 2%. The banks will reduce their lending rates on new loans by 1.8%. Example 2, RBI reduced repo rate by 2%, but the banks have reduced their lending rate on new loans by only 0.5%. So because of this lower transfer of benefit, right? I'm using a very simple statement. Because of this lower transfer of benefit to borrowers, can I say in example 2, new loans issued will be comparatively lower. At least now, is it okay? Why they will do it? How it is possible? We will understand it later. Please don't worry. But now tell me, because in the second example, the banks are transferring lower benefit to borrowers, right? Don't you think automatically the loans issued under example 2 would be lesser compared to example 1? So I will say, if you compare example 1 and example 2, transmission means what? Transfer. Transmission is nothing but transfer. So if you compare these two examples, right, the example 1, you are seeing a much better transmission of the benefits. Monetary policy changes are getting transmitted to customers in a much better way. Is it okay? Is it okay? Right? So that is a basic idea. That's a basic idea here. So example 1, you are seeing a much better transmission compared to example 2. Why this will happen, etc. Have patience. Have patience, my dear. Always you should have patience. I did not say it is over. Example is over. Discussion is over. No, have patience. I will come to that. Now, let's start. Right now, most of the loans issued, the banks are using two policies. One is called as marginal cost of funds based lending rate. Marginal cost of funds based lending rate. Second one is external benchmarking. Right now, external benchmarking is very, very famous. It has been introduced for the last couple of years. Even today it is there. This is very famous. So far, question has not been asked on external benchmarking. Let's start. What is this marginal cost of funds based lending rate? Marginal cost of funds based lending rate basically is an internal benchmarking. It is a benchmark means standard, which is used by the banking sector, where banks were considering certain parameters, internal parameters, and deciding their lending rate. For example, they were considering marginal cost of funds. Now we have come across the term cost of funds. What is this marginal cost of funds? Marginal means any minimal change, any minute or minimal change. Minute or minimal change is called as marginal. Marginal means small, minimal, or minute. Right? So minimal or marginal cost of funds. That is, let's say hypothetically, repo rate. If repo rate will change from 5.5% to 5.6%, can I say there is a marginal change by 0.1%? Please listen to me carefully. If repo rate will change from 5.5% to 5.6%, can I say that there is a marginal change, very small change in the repo rate by 0.1%. So marginal cost of funds, by small change, how cost of funds are changing, right? How much is the change in, right, the cost of funds, marginal cost of funds. Second, negative carry on the CRR, operational expenses, as well as tenor premium. Tenor premium means longer the tenure of a loan, higher rate of interest should be charged. Very simple logic. Longer is the tenure of the loan, you're taking a higher risk as a lender, you should charge a higher rate of interest. So under the marginal cost of funds based lending rate, banks were charging rate of interest based on these parameters. Every bank from one bank to another bank, the rate of interest used to change because the parameters, that is how much is operational expenses, how much negative carry is there, how much is the tenor premium, how much is their cost of funds, from one bank to another bank, it would change. And that would basically lead to, right, a decision on their lending rate. Now, please understand this. Although RBI decided these parameters, but RBI asked the banks to decide their lending rate. RBI said, take these parameters and decide your own lending rate. RBI found that there is generally inefficient monetary policy transmission. RBI generally found that there is an inefficient monetary policy transmission. Now, many of you ask me, how is that possible? It should not be possible, etc. Please tell me, think of this and please do let me know. If RBI will reduce a repo rate from 5% to 4% in the month of January, understand this very carefully now. If RBI will reduce a repo rate from 5% to 4% in the month of January, and the bank will reduce its lending rate, if the bank will reduce its lending rate in the month of October, do you think this is efficient monetary policy transmission? Let me know. I'll repeat it again. If RBI will reduce its lending rate from 5% to 4% in the month of January, and the bank will reduce its lending rate in the month of October, do you think it is efficient monetary policy transmission? And those who are having a doubt, sir, why it is not efficient, etc., etc., it means from month of January till end of September, whatever loans have been issued by the bank, don't you think they are charging a higher rate of interest? Yes or no? Does it make sense to you people or not? From January till the end of September, loans have been issued by the bank. Bank has taken a loan from RBI at lower rate of interest, but it has not reduced its rate of interest. Does it not mean if inefficient monetary policy transmission? And again, understand this. Some of you said, sir, why, right? Why example 1 can happen? Why example 2 can happen? Please tell me, operational expenses, profit motive. Don't you think from one bank to another bank will change? Correct or not? Right? Profit motive, right? Operational expenses, etc. will change from one bank to another bank. Some of the banks will simply say, though RBI has reduced repo rate, I will not reduce my rate of interest by large percentage. I will marginally change it. Another bank will simply say, okay, if RBI has reduced repo rate by 2%, I will reduce my lending rate by 1%. Some banks will say 1.2%. Some banks will say 1.5%. Some banks might simply say 2% also. So I hope you understand. Example 1 is also possible. Example 2 is also possible. But if most of the banks follow example 2 rather than example 1, I'll simply say the monetary policy transmission is inefficient. Is it okay? Right? So possibility is there, and earlier it has happened. Right? Earlier it has actually happened. Now that is the reason RBI simply said we introduced the concept of marginal cost of funds based lending rate. It was introduced in 2013. Before that, we had prime lending rate, benchmark prime lending rate, base rate regime. Different types of regimes were there. But post 2013 and 2014, we have introduced MCLR. And the whole objective of MCLR was RBI gave the parameters to the banks. Banks were supposed to decide the lending rate. So RBI felt that monetary policy transmission will be efficient. If the cost of funds for the bank will change, automatically they will adjust their lending rate. The new lending rate will be fair to the bank as well as to the customers, etc. But that did not happen. And that is the precise reason now RBI has introduced external benchmarking. Now RBI has introduced a new system called as external benchmarking. Now what is this idea of an external benchmarking? Listen to me carefully now. Rather than using any internal benchmark, right? Internal means bank's own benchmark, bank's own standard. Now please tell me, if RBI will introduce a new benchmark in the sense a standard again, and will tell the banks whenever this benchmark will change, I repeat, whenever this benchmark or the standard will change, you will have to adjust your lending rates automatically. I repeat, RBI will introduce a new benchmark or a standard, and if this benchmark will change, goes up, goes down, automatically the lending rate will change. Can I now say there can be a much more efficient monetary policy transmission. How so? Let me prove it. Let me prove it. Imagine repo rate is there. Imagine repo rate is there. Repo rate goes up. In the next 3 months, bank has to increase its lending rate. Repo rate is decreased by RBI. Repo rate is decreased. In the next 3 months, bank also has to reduce its lending rate. Now, please tell me, if this kind of a standard is introduced, benchmark, a standard is introduced by RBI, can I say this might lead to efficient monetary policy transmission? Think of it and do let me know. Please participate. That is, some of you will ask me, sir, how is that possible? How is that possible? Let me show it to you. I'll show you one example. Please do not worry about calculations. Most of you will be worried about calculation. Please do not worry. Let's say hypothetically, right now, you are taking loan from RBI and the repo rate is, let's say, 5%. Right now, repo rate is 5%. Now, along with this repo rate of 5%, you want profits, you want to take care of operational expenses, you are taking care of tenor premium, negative carry on the CRR, etc. For all of it, you will add, let's say, 6%, and now you will give a loan at 11%. You will give a loan at 11%. That 6% is nothing but operational expenses, profits, operational expenses, etc. So now you are giving a loan at 11%. RBI now says, if repo rate will come down from 5% to 4%, if repo rate will come down from 5% to 4%, automatically you will have to adjust your lending rate to 10%. Automatically you will have to adjust your lending rate to 10%. And please remember this. Some of you will simply say, but sir, bank can do it after 8 months. Banks can do it after 12 months. Banks can do it after 6 months. No, my dear. Every quarter, based on whatever is the repo rate, if the banks are following that, whatever is the repo rate, banks will have to adjust their lending rate. Is it okay? I'll repeat it again. For every quarter, if the repo rate has changed, for every quarter, the banks will have to adjust their lending rates. For example, let me know now. We are in the third quarter. All of you will agree? We are in the third quarter. That is October, November, December. And the fourth quarter will start in the month of January. So imagine RBI has changed repo rate in the month of October. Within this quarter, the bank will have to adjust its lending rate. Before it enters into a new quarter, it has to adjust its lending rate. RBI has a mandate now. Banks don't have any option. They will have to adjust their lending rate. And if RBI will increase repo rate from 5% to 6%, can I say now the bank's lending rate automatically will get adjusted? That is, of course, banks will do it to 12%. All of you okay with this now? Please do let me know. All of you okay with the idea of external benchmarking? The banks will have to connect their lending rate to a parameter, external parameter, not decided by the banks, decided by somebody else. And when that external parameter will change, when that external parameter will go up, go down, etc., automatically the lending rates of the banks will also keep on fluctuating, keep on changing like this. Now, because of this external benchmarking, can I now say the monetary policy transmission is going to become much more efficient? How the banks will decide the lending rate, you have idea now. If you have taken a loan, you have an idea how the banks are deciding lending rate. You have clarity regarding that. Because now you know if repo rate goes up, your lending rate will go up. If repo rate will go down, your lending rate will also go down. This policy is called as external benchmarking. This new type of policy introduced by RBI for giving loans. Housing loans are given by external benchmarking now. MSME loans, micro, small, medium enterprises loans are given on external benchmarking. Under this, right, basically the idea is monetary policy transmission will be very, very efficient. Rate of interest charged, how it is calculated, transparency is there, right? How much rate of interest is charged to the customer will know that. right? It is fair always to the customer as well as the banks. Now, if you want to check it in real life, if you want to check it, because I know it, I have a housing loan, I know it. If your parents have taken a housing loan, if you have taken a housing loan, if any of your relatives have taken a housing loan, please ask them what has happened to their rate of interest in the last 1.5 years. Just ask them what has happened to their rate of interest that they're paying on a housing loan. What has happened to that in the last 1.5 years? The uniform answer will be the rate of interest in the last 1.5 year has increased. Right? The rate of interest on the housing loans has increased in the last 1.5 year. And now repo rate also has increased in the last 1.5 year. Please tell me, is there a connection that you are able to establish between both of them now? In the last 1.5 year, fact is simple. Repo rate has been increased by RBI. And if I also tell you the rate of interest on the housing loans also has increased, is there a correlation between both of them? That is because of the increase in the external benchmark, automatically the rate of interest also on the housing loans, MSME loans have increased. This concept is called as external benchmarking. Most of the banks in India are using repo rate as an external benchmark. If repo rate goes up, their lending rate will go up. If repo rate will go down, their lending rate will go down. But apart from repo rate, can they use any other term apart from repo rate as a standard, as a benchmark? They are allowed to use the treasury bills, 91-day, yield rate of 91-day treasury bills, yield rate of 182 days at treasury bills. In fact, there is one more authority in India, institution in India, Financial Benchmarks of India Limited, FBIL. Financial Benchmarks of India Limited. They can even use the indices which are published by FBIL. But most of the banks are using repo rate in India. Okay, they're using repo rate. Done? Can we go forward now? Anybody has an issue regarding lending rates? Let me know. Even after sudden hike, it will be far lower than FD rate. Even after sudden hike means you are talking about repo rate or lending rate. Isn't inefficient empty example of profiteering? Not necessarily, because right, there are various arguments given by the bank. Right? For example, you can take a loan from RBI as well as others also in the market. So please understand this. You can take a loan from RBI as well as others in the market. Let me give a very simple example, extreme example, but just to make you understand. If all of your loans, I repeat, all of your loans are from RBI under the repo rate. So any small change in the repo rate, it will directly affect you. All of your loans would be affected, assuming you're a bank. On the extreme side, imagine you have taken 0 rupee loan from RBI. Again, it will not happen, but extreme side, just to make you understand. Right? Even if you have taken 0 rupee loan from RBI, if a repo rate will come down by 2 percentage points, please tell me, if you have taken 0 rupee from RBI in the form of loans, will it affect your cost of funding? Please think of it and do let me know. If you have taken 0 rupee from RBI and RBI will reduce the repo rate or increase the repo rate, will it affect your cost of funding? Absolutely no. So I hope you understand. It is generally a mix. Some of it will be from RBI, some of it will be from customers, right? Companies, individuals, etc. So cost of funds is not just repo rate. It is basically a weighted average of all the loans taken by the bank. And that's the reason earlier, not necessarily that if you do not reduce by 2%, is it profiteering? Not necessarily. Okay. FBIL means what? Financial Benchmarks of India Limited. There is one institution in India which publishes a lot of indices. The name of that authority is called as Financial Benchmarks of India Limited. Okay. So if the borrower fails to repay the loan to the bank within the destined time, okay, I'll discuss that later. Don't worry. What will happen if you do not repay? What is the concept of NPA? We'll discuss that later. Bank rate and repo rate is usually lower than fixed deposit rate. Why would the banks entertain FD while they can lend all money from the bank rate and repo rate? My dear, please understand, sometimes The banks will find it very difficult to borrow from RBI because RBI also has certain limitations. RBI also has certain limitations. Beyond limitations, RBI cannot keep on lending. In such situations, banks are allowed, because please understand this, the interest rates are not regulated by RBI. Interest rates on the bank deposits are not fixed by RBI, right? RBI can impose restrictions, but it doesn't fix it for banks. Banks are allowed to decide based on their requirement how much interest rate they want to give to the customers. So if the banks are finding it very difficult to collect the deposits, they are even finding it very difficult to get loans from RBI, it will happen. What if repo rate facility is not available? Think of it. Many of you simply say, sir, how is that possible, etc., etc. What if repo rate facility window is not available to you right now, but you need funding, you need money, you need to collect more and more deposits? Automatically, banks will start giving you a higher fixed deposit rate. Banks are allowed to do that. They are allowed to do that. Okay. Sir, can banks change its lending rate as soon as change in repo rate, or should they wait? Banks wait till tenure period ends? No, right? Generally, please understand. There earlier there was a concept of floating rate. Floating rate means rate of interest will keep on changing. The idea of external benchmarking is the similar, right? Same rate of interest will keep on changing. If RBI will change the repo rate, and if the bank is following repo rate to decide its lending rate, in this quarter, before the quarter will end, they will have to automatically adjust their lending rate. That's the argument. Sir, if bank does not borrow money from RBI, then the change in repo rate is bound to change in a lending rate of a bank. No, not directly, but in different way, yes. Because you have not taken any loan from RBI, if repo rate changes, it will not have any impact immediately on you. Basically, because repo rate is the most important rate, other interest rates will change. But I'm just telling you, right? Again, it will not happen. There is no bank in India which has 0 rupee loan from RBI. They take loan from RBI and they will use it for lending purposes. But there is a mix. There is a mix. Some of it is from RBI, some of it from customers, such as individuals as well as companies. So the rate of interest will keep on changing. Cost of funding is the average, weighted average. Okay, let me take a break now. Let me take a break. We will take a break. We'll restart the discussion at A2. Take a break. We'll restart the discussion at A2. Okay. Okay, welcome back. Welcome back. Am I audible? Please do let me know I'm audible. Can we start now? Okay, thanks a lot. Okay, some of you are asking, sir, Hindu newspaper articles. Which are the articles? From today's Hindu newspaper, three articles. I would want you people to read three articles from today's Hindu newspaper. Again, I'm targeting only Hindu newspaper. First one, central page. Central page, there is an article regarding, that is open editorial. There is an article regarding IMF and debt report for India. IMF and debt report, central page. Please read that. First article. Second article. So today means which day? 26th December. 26th December, right? So IMF and debt, central page, there is article. Please read that. And the business page. Business page. There is an article on India ASEAN. India ASEAN free trade agreement. We'll discuss that when we take up international trade. I'll tell you what has happened, etc., why it is happening, what we are trying to do. But read that. If you understand, good. Otherwise, please don't panic. We'll discuss it. Third article, just beside business page, just beside this India ASEAN trade agreement article, there is an article regarding stagflation. This should not be very difficult. Again, please do not read the article or as well as the technical concepts in those articles. Right? They have given that is information regarding the survey, the methodology, that formula, this formula. Don't panic. Don't worry about all of it. Those formulas are no way important, right? No way important for UPSC. Do not worry. But supply side, demand side, stagflation, right, fiscal, all these terminologies are used. That should be important for you. So stagflation article is there. These three articles are important. As far as I'm concerned, today's Hindu newspaper, these three are important. Please read that. So let me get back to the point at hand, the Basel guidelines. Next concept will be Basel guidelines. Okay. I did not find the first article. My dear, central page. Please go to the central page. Hindu central page is like this. If this is the Hindu central page, that is where the open editorials, etc. are there. Left side, right? Left side, the first article. Left side, the first article is that only. Editorials. Please read that. This is the article that I'm talking about. IMF and debt report. Okay. Now, let me start. Let me start the discussion here. Basel guidelines, important for UPSC exam. Prelims one question has been asked on this. The idea of a Basel guidelines. Now, what is this Basel guideline? Point number one, please understand. Basel is a place. It is a name of a city. Basel is a name of a city, right? It is not anything else. It is a name of a city. Do not be confused. It's a name of a city. It's a name of a city in Switzerland, and in this city there is a international banking unit, right? I'll come to that. Don't worry. There is some grouping of international banks or the banks around the world. Central banks have come together. We have formed a grouping there, and that is the reason this is called as a Basel guideline. Now, to understand Basel guidelines, what are the important basic concepts? Point number one, every bank will have a certain amount of money. We'll call this as a capital of a bank. Is it okay? Every bank will have certain amount of money. We'll call this as a capital, right? So the capital of a bank, the money that is there with the bank, will be divided into two parts, tier 1 and tier 2 capital. I'll repeat it again. If you want to start a company, you will invest money, that is called as capital. Every company will have its own capital. In the same way, bank also has money, that is called as capital. This capital is divided into two parts. One is called as a tier 1 capital and tier 2 capital. Tier 1 is called as the core capital. Tier 2 is called as supplementary capital. Please by heart this. Please by heart. Tier 1 is called as core capital. Tier 2 is called as supplementary capital. What is the example of tier 1 capital and tier 2 capital? And what is the importance of tier 1 and tier 2? Let me start with a very simple example. Listen to me carefully. Imagine, I'll give you 200 rupees. I'll tell you, right, first 100 rupees, right, is the money that you can use at any point of time. Imagine you need money, you can use this 100 rupee, right? You have certain amount of cash in your pocket. I'll repeat it. Imagine you have certain amount of cash. If this cash The amount of money that is there in your pocket falls down to, let's say, 300 rupees or let's say 200 rupees. At that point of time, you can take this 100 rupee and start using it. And the remaining 100 rupees, you can use it only when there is no cash in your pocket. I'll repeat it. Just understand the example here. I'm giving you 100 rupee and I'm telling you this 100 rupee in your purse, if the cash is below 200 rupees, use it. And another 100 rupees I'll give you. I'll tell you, you can use this only when there is absolutely no cash with you. Now, right, is it okay if I say the first 100 rupees, is more important for you compared to second 100 rupees? Is it okay? The first 100 rupees is more important for you. Why? You can use it well before. I'll repeat it, right? You can use it. Both are important. I'm not saying the second 100 is useless. The first 100 rupee note, you can use it well before you are allowed to use the second 100 rupees. Anybody has a problem with this? Please do let me know. I'll repeat it again. 100 and 100. The first 100, use it if the cash is below 200. The second 100 rupees, use it only when you do not have any cash. Both the 100 rupees are important for you. I'm not saying none of it is important or any one of it is unimportant. But I'm saying because you can use the first 100 rupees much sooner, much before this second 100 rupee, can I say your reliance on this, the importance of this 100 rupee will be slightly higher. Can I go forward with this example? Anybody has difficulty in understanding this example? Again, I'm not saying the second 100 is not important. I'm saying because you can use the first 100 much earlier, I'll give more importance to the first 100 rupees. Now, apply the same logic to the bank. The bank has lot of capital, money in simple terms. Lot of capital is there with the bank. What is the use of the capital? The bank will utilize the capital to absorb losses. I'll repeat it, right? The bank can utilize this capital to absorb losses. Absorb losses means what? Imagine the bank has incurred a loss of 100 rupees, 200 rupees, 100 crore rupees. Loss means simple, expenses are higher compared to income. Is it okay? Expenses are higher compared to income. That is your loss. So now, how do you address these losses? How do you absorb these losses? You're allowed to use the capital to absorb these losses. But only condition is, first, you will have to use a tier 1 capital and then you'll have to use a tier 2 capital. So now please tell me, based on this, can I say for a bank, its reliance on tier 1 capital will be much more compared to tier 2 capital? I'll repeat it. Its reliance on tier 1 capital will be more compared to tier 2 capital. Anybody has difficulty in understanding this concept, please do let me know right now. When the amount of money that you have will keep on falling, the capital will keep on falling at certain level, the bank is allowed to use a tier 1 capital first to absorb losses. And after that, the bank will be allowed to use tier 2 capital. It is difficult. It is very complicated. My goodness. Okay, let me repeat it. Okay, you're running a company. Let me take another example. Right, let me repeat it. You're running a company and you incurred losses. Please tell me what you mean by a loss. You should know what is the meaning of a loss in the first place. Otherwise, very difficult. What is the meaning of a loss? Can I say loss simply means your expenses are higher compared to your income? Anybody has difficulty in this? Point number 1. Let me know. What do you mean by losses? Your expenses are higher compared to your revenue, your income. Imagine your expenses is 100 rupee, your income is 80 rupee. Now, what do you mean by absorption of losses? What do you mean by absorption losses? Can I say somehow you will have to adjust for additional expenses of 20 rupees? Let me know. Somehow you'll have to adjust for additional expenses of 20 rupees. You'll have to show there is some 20 rupees, some from somewhere you have got this additional 20 rupees. Now question is, from where will you get these 20 rupees? Absorption of losses. From where will you get it? You will get it from your capital. Capital is nothing but the money that is there with you. Capital is nothing but the money that is there with you. You will use your capital to absorb these losses. Right? Second point is clear with all of you. Now within capital, the money that is there with you, I will divide this into two parts. Tier 1 capital and tier 2 capital. I'll divide this money that is there with you into two parts, tier 1 and tier 2. But I will tell you, before using tier 2, before you are allowed to use a tier 2 capital, you should first use a tier 1. To absorb losses, you should use a tier 1 capital first, and then you should use a tier 2 capital. Which means please understand the next point now. Can you rely more on tier 1 capital to absorb losses? Yes or no? Compared to tier 2. At least now please answer me. Will you not rely more on tier 1 compared to tier 2 to absorb losses? Your dependency will be more. Some of you say, but sir, conditions are there, etc. Conditions are there. But I'm saying you can use a tier 1 earlier compared to tier 2. In fact, understand this, there is a technical concept. Technical, right? Chartered accountants, commerce students will be happy. Tier 1 capital is called as going concern capital. Going concern capital. Whereas tier 2 capital is called as gone concern capital. Means going concern, issues are there, problem is there, but the capital that you have will be, you will be able to use it to ensure that the company will operate. Company will continue to operate. Going concern capital. Gone concern means company is going to close down. Right? Only then you are allowed to use this capital. So at least now all of you okay? Can I go forward? Can I go forward? I'll give you examples of both tier 1 and tier 2. But tell me now, based on this discussion, can I come to a conclusion? For a bank, its reliance on tier 1 will be more compared to tier 2. Okay. Now, what is this tier 1 capital, tier 2 capital? I'll give you one examples, more than sufficient. Additional tier 1 bond and a tier 2 bond. Additional tier 1 bond and tier 2 bond. Additional tier 1 bond is an example of the tier 1 capital, and tier 2 bond is an example of, right, tier 2 capital. Now, what is this additional tier 1 bond? What is the tier 2 bond? Let me explain. Whenever the banks will issue bonds in the market, the banks are issuing bonds in the market, collecting money from the investors. Now, two types of bonds are used by the banks. One is called as AT1, additional tier 1, and the second one is tier 2 bond. Let's start. Right, let's start. Right, imagine this is a bond. And again, please understand, do not look at maturity period. I'll repeat it. Look at the bond. Please do not worry about maturity period. Do not worry. Do not look at maturity period and start correcting me. A bank will issue this bond, collect money from you. Bank will issue this bond, collect money from you, and give you certain interest rate. But the feature of this bond is that there is no maturity period. Feature of this bond is there is no maturity period. What do you mean by this? The one who has issued this bond will decide. I repeat, the one who has issued this bond will decide when they want to repurchase it from you. Is it okay? I'll repeat it again. Listen to me very carefully. I'm issuing this bond to you. Do not look at maturity period. There is no maturity period. I will issue it. I will offer you coupon rate. But unlike a normal bond, there is no maturity period for this bond. I will sell it to you. I'll collect money from you. I will decide when I will repurchase it from you. Can I call these bond as perpetual bonds? Let me know. Can I refer to these bonds as perpetual bonds? Perpetual bond means no maturity period, right? There is absolutely no maturity period. These are perpetual bonds. So remember this, additional tier 1 bonds. 81 bonds are perpetual bonds. These are unsecured. These are unsecured. Unsecured simply means no security, no collateral is provided. No security or no collateral is provided. So unsecured perpetual bonds that the banks will issue to shore up their capital base in order to meet Basel norms. We'll discuss Basel norms after this. On these, the banks may skip paying the coupon in certain extreme situations. What is the meaning of it? Listen to me carefully now. Do not worry about maturity period. Lot of you will start correcting me now. Do not correct me on maturity period. Please look at the bond and tell me what is the coupon rate. Let me know. Please look at this and tell me what is the coupon rate. Coupon rate is 6%. So in case of additional tier 1 bond, if the bank is facing a situation that is sufficient revenue is not there, they are incurring losses, etc. In certain cases, the bank might simply say, I will not give you this coupon rate. The bank might simply say, I will not give you this coupon rate. In fact, in extreme situations, banks might simply say, after getting RBI's approval, bank might simply say, I've given this bond, I've collected 100 rupee from you, I will not return the principal also. Is it okay? Right? In extreme situations, the banks who have issued these bonds, they may skip paying interest payment, coupon payment. And in extreme situations, after getting the approval from RBI, the banks might simply decide not to pay the principal amount itself. They will not repay the principal amount. Now tell me, looking at this, are these bonds risky or not? Are these bonds risky or not? Answer is yes. These bonds are very, very risky. These bonds are very, very risky. And that is the precise reason. These bonds, whenever they're issued by the banks, these bonds generally offer a higher coupon rate. These bonds, right, generally offer a higher coupon rate. They should offer higher coupon rate. Otherwise, what will happen? You are taking very large risk, but you are not earning sufficient returns. These are very, very risky bonds. Done? Second, tier 2 bonds. Tier 2 bonds. Listen carefully. These are unsecured. Just like additional tier 1, these are unsecured. But please remember this, these will have maturity period. These are unsecured, but these will have maturity period, right? The issuer, the one who is issuing it, before they will issue it, they would have decided maturity period. Now, please tell me, is there a maturity period for this bond or not? All of you will agree there's a maturity period? The issuer, if I'm selling this to you, I am telling you what is the maturity period. So tier 2 bonds will have a maturity period. Tier 1 bonds, no maturity period. I will decide. I might purchase it after 5 years. I might purchase it after 10 years. That is left to me. But in this example, there is no option for me. After 3 years, I will have to repurchase it from you. I will have to buy it back and give you the principal. But please understand, next important point. Although there is a maturity period is there, the tier 2 bonds can also be cancelled by the banks. Tier 2 bonds, just like additional tier 1 bonds. That is, in additional tier 1 bond, the bank said, I don't have money, so I will not return the principal. In tier 2 bond also, the banks might simply decide they will not give you a coupon payment. They will not give you, right, the repayment of the principal. That is also allowed in case of tier 2 bonds. In fact, you should not be asking, sir, why it is allowed. Why it is allowed in case of tier 1 as well. I'm sorry, additional tier 1 and tier 2 bond. Why is it allowed for the banks to cancel off the debt like this? Please tell me, by removing the debt component. Understand this, right? Remember the concept of balance sheet. By removing the debt component, can I use this money to absorb losses? Think of it now. Let me know. by removing the debt component, removing debt component means what? I'm supposed to repay this 100 rupees to you. I've collected 100. I'm supposed to repay 100. If I do not repay this 100 rupee, can I use this 100 rupee to absorb my losses now? At least now all of you okay with this? How tier 1 and tier 2 capital is used, what is the importance, etc. And some of you are asking, sir, why should we use tier 1 after, before tier 2? My dear, please tell me, if you're owning a company, there's always a sequence. If you're owning a company, will you not use the manufacturing unit last to absorb losses? Last means first, if you have any money, you will use that money to absorb losses. If that is not sufficient, then you will start selling trucks. You will start selling, right, let's say machines. You will start selling the land that you own. Is there a sequence to that or not? Think of it. Is there a sequence or not? If you have cash, even then, after having cash, will you sell your land to pay off or to absorb your losses? Who does it? Think, please think logically. You have cash, sufficient cash you can use this to absorb losses. How many of you, despite having cash, will sell off machines that you will use to manufacture to pay off or to absorb your losses? If you sell off your machines, if you sell off the land, if you sell off your, it's a manufacturing facility, does it not mean you're closing the company? So I hope you understand the logic behind it. I hope you understand the logic. Tier 1 capital is more liquid. It can absorb losses much before tier 2. That is the reason tier 1 is more reliable compared to tier 2. Banks will use tier 1 first and then they will use tier 2. Okay. So additional tier 1 bonds and tier 2 bonds. These are there in the newspapers. You will generally not get these in the books. These are there in the newspapers. For example, how many of you heard of Yes Bank? Let me see. How many of you have heard of Yes Bank? The debacle at Yes Bank. Yes Bank had issued the tier bonds. Yes Bank had issued tier 1 bonds, additional tier 1 bonds. They simply cancelled the additional tier 1 bonds. The investors in these additional tier 1 bonds have dragged Yes Bank to Supreme Court of India. Read it. That is the reason I'm talking about all of these. These are technical, I know that. But suddenly UPC can ask you all of this because it is there in the current affairs. Yes Bank issued additional tier 1 bonds. They absorbed it. And when they incurred losses, Yes Bank said, after getting approval from RBI, of course, they said, we are not going to repay your, let's say, principal amount. We will not repay it. Investor said, how come? No, will not accept it. They have dragged Yes Bank to Supreme Court of India. Right, the case is there in the Supreme Court of India. So that is the reason, that is the reason. Please remember, additional tier 1 bonds, any money that is collected will go to basically the tier 1 capital. Tier 2 bonds will go to the tier 2 capital. Right, but additional tier 1, it can absorb losses much faster, much before compared to tier 2 capital. Done. So can we go forward now? Can we go forward? Right, couple of more basics. Why will RBI give approval for such bonds? My dear, always remember this. Any amount that you invest in the market, any amount, is always risky. But the component of risk, the magnitude of the risk will always keep on changing. Magnitude of the risk will always keep on changing. Any investment that you is risky. There is no investment in the market which can claim 0% risky. Generally, when we give it to government, we generally say 0%. But any investment that you do, you will invest in, let's say, mutual funds. Is it not risky? Of course, yes. You will keep deposits in a bank. Is it not risky? What if the bank incurs a loss? It is going to shut down. Of course, yes. You will invest in the shares of a company. Is it not risky? Of course, yes. Right. So I hope you understand, any amount of investment that you do in the market is risky. But how much is the risk? What is the magnitude of the risk? That will keep on changing. Okay. Now, whenever you talk about a bank, there are 3 types of risk. One is called as a credit risk, market risk, and operational risk. Listen to me very carefully. Let's go one by one. Credit risk. Bank has given a loan to a customer. The customer doesn't repay the loan. That is called as credit risk. All of you okay? All of you okay? I'll go to the second one. I'll repeat it again. Credit risk simply means loans are issued, credit is issued. The borrower does not repay the loan. That is a risk for a bank. Because of this risk, bank can incur a loss. Credit risk. Second one, market risk. Bank will invest in this bond. Right? Listen to me very carefully. Bank will invest in this bond. Can the market price of the bond fall down? Imagine this is a government bond. Bank will invest in this bond. The market price of the bond, can it fall down? Of course, yes. What if bank will purchase the bond at 100 rupee and will sell it when the market price is 95 rupees? Is it going to lead to a capital loss of the bank for the bank or not? Is it risky? Of course, yes. So market risk, the risk of losses arising from movement in the market. I'll give you one more example. Bank will give you a loan of 1 crore rupee. Let's say bank will give you a loan of 1 crore rupee for a house, for purchasing house. And the value of the house as per today's market situation is, let's say, 1.2 crore rupee. Now there is another wave of pandemic. The whole market, let's say, will shut down. The housing market will crash. Don't you think the market price of this house will fall down from 1.2 crore, let's say, to 70 lakh rupees? Possible or not? The market price of this house, can it fall down with a crash in the housing market? Of course, yes. Let's say the borrower loses the job, unable to repay. The bank will simply confiscate the house and sell it in the market. Now tell me, because of the market movement, is the bank facing a loss in this transaction or not? That is, it gave a loan of 1 crore. Now it will take possession of house and sell it in the market, but recover only 70 lakh. Is it not a loss because of the market movement for a bank? Of course, yes. So there are a lot of market situations. There is a lot of volatility in the market, fluctuations in the market. Such kind of market movements can lead to losses for a bank. That is called as market risk. And the third one, and one student says, sir, please repeat operational risk. You should not say repeat, because I have not yet gone to the third one. Let me go to the third one now. What is operational risk? Any risk that will lead to losses for a bank. I repeat, any risk that will lead to losses for the bank because of systems, because of people, because of technology, etc. That is called as operational risk. Sir, what do you mean by this? Can you give an example? Let's say I'm a cashier. I'm sitting in a bank. I'm a cashier. You will deposit huge chunk of money. You will deposit a large amount of money. I'll start counting, right, and taking the deposit like this. But because, right, I'm very quick in counting, I'm not focused in counting. In the process of it, can I make a mistake and simply collect one 2000 rupee note, which is counterfeit currency? Please understand this, right? Any problem, let me know. You will deposit money with the bank. Let's say you will deposit 1 lakh rupees. I'm counting, I'm in hurry, I'm counting. But in the process of counting, I missed one currency note, which is a counterfeit currency note. And I will simply take it and I'll give you in writing saying that you have deposited 1 lakh. Now, please tell me, can that 2000 rupee note, can it be counted as a loss to the bank, right? Because of a person, because of a system, because of a process. That is operational risk. That is simply an operational risk. Any losses that can arise because of systems, because of technology, because of people, that is called as operational risk. Can we go forward now? All of you okay with credit risk, market risk, and operational risk? Can we go forward? Anybody has a problem? Please do let me know. Is counterfeiting still happening? My dear, counterfeiting will keep on happening. If you stop 2000 rupee note, supply of 2000, they will counterfeit 500 rupee note. Very simple. Counterfeit will keep on happening. Can we say that AT1 bonds are more risky for customers? Of course, yes. More than tier 2. It is more risky. Okay, because first AT1 bonds will be written off. Only then they will target tier 2 bonds. Yes, sir. But in this case, a bank can acquire something else to recover their loss. Are you talking about market risk or what? Please do let me know. So credit risk in simple words, borrower doesn't repay. A person who has taken the loan doesn't repay the loan, my dear. Right? This is not difficult. Imagine you will give a loan of 100 rupee to me. Forget about bank. Imagine you have given a loan of 100 rupee. I will not repay it. Are you going to incur a loss of 100 rupee or not? Are you going to incur a loss of 100 rupee or not? Of course, yes. The borrower will not repay the loan. That is a credit risk. Okay. Sir, operational risk not clear. There can be a machine. My dear, please tell me. In all the branches in India, are there machines to count currencies? How many of you think that is correct? Let me know. According to you, because you live in a very big city, because you have seen a machine in 2 or 3 branches, does it mean cash counting machines are present throughout all the bank branches in India? No, that is not a fact. That is not a fact. Right? In fact, it's not a fact because there are many banks, rural part, rural villages. No, right? It's not a fact. Moreover, let's say theft in ATM machines, cyber frauds. Right? There are multiple cases, multiple situations where banks will incur losses because of systems, because of people, because of process technology. All of that collectively is called as right operational risk. Okay. Okay. Let me go forward. Okay, sir, I've seen machine counting machines in all the banks. Good. In that case, ignore counting machines. Shift to another one. Shift to another example. What about cyber frauds? What about theft in the ATM machines? Write that an example. Okay, anyways. Okay. Now let me go to the next concept. Risk weighted assets. RWA. Risk weighted assets. This was there very recently in the newspaper. I don't know how many of you are reading newspapers, but this was there very, very recently in the newspaper. Yes or no? RBI has increased the risk weightage for credit card loans. RBI has increased the risk weightage whenever the loans are given to NBFCs. What is this idea for risk weightage assets? Argument is simple. Whenever loans are issued by the bank, all these loans will carry certain risk. But please tell me, can I treat 2 loans? Think of it very carefully. Imagine the bank has given loan to one customer who has provided security to the bank and another customer who has not provided any security. Now, please tell me, if the loan of 100 rupees given, should you treat both of the loans in the same way? Should be giving equal weightage to both of the loans? Answer is no. Why? In one of the loans, because you have not collected any security, I repeat, in one of the loans, because you have not collected any security, don't you think risk weightage, the risk of this loan is very, very high for the bank? All of you are able to understand the concept of risk weightage here? The banks are giving loans, but based on the borrower, whether the security is there, etc., all the loans are not having same amount of risk. Some of the loans will carry very high risk, some of the loans will carry very low risk. For example, some of you will ask, sir, any type of loan where collateral is not taken? My dear, credit card. Let me know now. Credit card. Those of you who have a credit card, those of you who have used a credit card or thinking of applying for a credit card, is it not a concept of a loan only? You will use the credit card to purchase a mobile phone today, but you will repay this amount to the bank in the future. Is it not a loan? Of course, yes. But when you take a credit card, do you think the bank is collecting security from you? All of you okay? Right? Okay with this example? When you take a credit card, do you think bank is taking a security or collateral from you? Absolutely no security is collected. No collateral is collected. So I hope you understand, when the loans are issued by the banks, all the loans will carry certain risk except given to government. Government generally carries 0% risk. But other loans will have a different amount of a risk. That is the concept of risk weighted assets. Now, why should we calculate risk weighted assets? Please tell me. If a bank has given loans, is there a possibility that bank might incur losses because of these loans? Think of it. Please do let me know. If a bank has given loan, they are facing a risk. And is there a possibility that because of these loans are assets, by the way, right? Because of these loans, banks might incur losses. So now there might be losses for the bank. If these losses are there, how much capital you should maintain to absorb the losses? For that, we calculate risk-weighted assets. For that, we calculate risk-weighted assets. For example, do not by heart the table. Please do not by heart this table. It's of no use for you. Just to make you understand how risk-weighted assets are calculated, let's imagine the bank has given 3 loans. Let's imagine, again, hypothetical calculation, understand the statement. Do not keep on arguing why 50%, why not 80, why not 100. Do not argue. Hypothetical calculation. Let's say loan 1, there is no risk, absolutely safe. Let's say to Government of India, I'll give a risk weightage of 0%. Loan 2, I've given a risk weightage of 50%. Loan 3, I've given a weightage of 80%, which means out of 1 lakh rupee total loans issued by me, out of 1 lakh rupee total loans issued by me, assets that I've issued, out of that, total 31,000 rupee is risk weighted assets. All of you okay with the calculation? Right? Loan 1 is 50,000, 0% is risky. So risk weighted asset is 0 rupee. Second loan is 30,000, 50% is risk weightage. 15,000, 15,000 rupees is risk weighted asset. Third loan is 20,000, so 80% risky, right? So which means out of 20,000, 16,000 rupees is risk weighted asset. So out of total assets, I've issued total assets of 1 lakh. I have total assets of 1 lakh. Total loans issued is 1 lakh. Out of that, 31,000 rupee is a risk weighted asset. Anybody has a problem? Please do let me know. This is how risk weighted assets are calculated. Very recently, RBI has asked banks to change risk weightage for various types of loans they are issuing. The loans that they're issuing for NBFCs, risk weightage has been increased by 25%. Loans that they're issuing in the form of credit card, risk weightage has been increased by 25%. All of you okay? Can I go forward now? Can I go forward? Why not secure, provide for customer too, my dear? Again, same argument. When you give a loan to a customer in the form of credit card, you do not take security. Is it difficult to understand? You will issue a credit card. You are a bank, you will issue a credit card. You do not take security. You do not take collateral. Education loans generally are unsecured. So those kind of loans where you do not take security, risk is very high. Okay, so who will decide this particular risk weightage? RBI. RBI, based on various parameters, they will decide the risk weightage. You don't decide it. You don't enter into that also. Just stick to the idea. Okay. Now, what is the use of all of this? We will use all of this to calculate a formula called as, or we will calculate something called as CAR, capital adequacy ratio, or else another technical name for this is credit to risk weighted assets ratio, right? Capital to risk weighted assets ratio, CRAR. CAR, capital adequacy ratio, or capital to risk weighted assets ratio. And what is the use of CAR? Understand this very carefully. Imagine if the capital adequacy ratio is 9%. I'll repeat the statement. Imagine if the capital adequacy ratio is 9%, it simply means a bank which is issuing loans where the risk weighted assets are worth 100 rupee, then the bank must maintain 9 rupee, at least 9 rupee in the form of capital. Is it okay? I'll repeat it again. Listen to me very carefully. If a bank is given a capital adequacy ratio of 9% target, what does it mean? If the risk-weighted assets, if the risk-weighted assets of the bank are worth 100 rupee, then automatically the bank must maintain at least 9 rupee in the form of capital. And what is the use of this capital? The capital will be used to absorb losses whenever the banks are going to incur losses. And the banks are going to incur losses because of risk-weighted assets. That is the whole argument here. Right? So capital adequacy ratio represents the ability of the bank in meeting the needs of the creditors and depositors. That is, how much capital is there in the bank to continue to operate, to absorb losses and to continue to operate. That's a basic idea of capital adequacy ratio. Can I go forward now? Now, please do let me know if RBI will increase the risk weightage asset. I'll repeat it. If RBI will increase the risk weightage asset and keep the capital adequacy ratio same 9% only, then does it not mean bank has to keep more capital to absorb losses? I'll repeat the statement. Listen to me very carefully. Right? RBI has increased the risk weightage of the assets. Right? Credit card loans, increase it to 125%. NBFCs increase it to 125% if the risk weightage of assets RWA is increased. And let's assume car is still 9% only, then does it not mean the bank has to keep more capital now, has to have more capital in order to absorb losses? All of you okay? All of you okay with this? And now what is the impact? Please listen next. If risk weightage increases, bank has to keep more capital. Does it not affect its lending activity? Think of it. Right? The risk weightage increases. Bank has to keep more capital. As a result of this, if you keep more capital to absorb losses, don't you think automatically your lending, the amount that is there for lending activity would be lesser? There will be a constraint on it. Lesser lending will take place. All of you okay? Anybody has a problem? And if you're lending less, right, the amount that is available is lesser, and because you are keeping more money now in the form of capital, you're keeping more money, idle money is more, and your lending is affected, will it not affect your lending rate? Let me know. Will it not affect the rate of interest that you start charging on these kinds of loans? Yes? Can I go forward now? Let me know. Can I go forward? Anybody has a problem? Arey Baba, sir, very difficult, very complicated. Point number one. If risk weightage of assets will increase, let's say at capital adequacy ratio of 9%, to meet 9%, let me give a very simple example. Earlier risk weightage assets was 100 rupee. To meet 9% capital adequacy ratio, your capital should be 9 rupees. Correct? Capital should be 9 rupees. But now risk weightage is increased to, let's say, 125%. Don't you think automatically the denominator will increase? Denominator will increase, let's say hypothetically, it will increase, let's say, to 120 or 120 rupees. Let's say hypothetically to 120 rupees. And if it increases to 120 rupees to meet 9%, to meet capital adequacy ratio of 9%, now you'll have to keep capital of how much? Minimum 10 rupee 80 paisa. Correct? Minimum 10 rupee 80 paisa. Right? So now the amount of capital that you'll have to maintain, you cannot use it for lending. You'll have to maintain with you now. The amount of capital that you'll have to keep with yourself in order to absorb losses becomes 10 rupee 80 paisa. Will it not affect your lending activity? Of course, yes. You're keeping more money idle now, which means your lending activity will be affected. And when your lending activity will be affected, right, automatically the lending rates, the rate of interest on these loans will start increasing. On these loans will start increasing. That is the impact. Anybody has a problem with the sequence here? Is there anybody who has a problem with the sequence? Understand the sequence. Suddenly UPSC can ask you assertion and reasoning question on this. Or they might ask you, right, which of the following are likely to happen with a higher risk weightage. All of these are possible in the next year prelims. Can we go forward? Car is maintained in the form of tier 1 and tier 2. My dear, tier 2 capital plus tier 1 capital will give you total capital. All of you okay? Tier 1 capital plus tier 2 capital will give you total capital. Now, what is the difference between car and SLR? Now, please tell me, can you use your SLR amount to absorb losses? Think of it and do let me know. Can you use your SLR money to absorb losses? Did we discuss that earlier? That you can use SLR to absorb losses? No, no, my dear. You cannot use SLR to absorb losses. You can use SLR whenever there is liquidity constraint on you. Depositors are coming to you, right? They want to withdraw money. You have taken part of the deposit maintained in the SLR. You will sell the G securities, get the money, allow the depositors to withdraw money. Right? So SLR is a tool which can help you in maintaining liquidity in the bank. Okay. Let me go to the next, Basel norms. Basel is a place in Switzerland. Right? Some of the students were asking, despite saying, tell me what is Basel? Basel is a city. It is a city in Switzerland. Now there is a Bank of International Settlement in Basel. In this city, there is one institution where central banks are party members. Bank of International Settlement. RBI is a member of BIS. Now the BIS has formed a committee. BIS has formed a committee, and the name of the committee is Basel Committee on Banking Supervision, BCBS. The BCBS every now and then will come out with regulations which are applicable to banking sector. BCBS will come out with regulations or a framework that is applicable to banking sector. So far, three such frameworks, three such rounds of regulations have been announced. Basel 1, Basel 2 and Basel 3. What is Basel 1? It was announced back in 1988. India has implemented Basel 1 already. RBI has implemented Basel 1. By 1999, we have implemented Basel 1. Under Basel 1, they identified only one risk. Remember this. Under Basel 1, they identified only one risk, credit risk. Now, please do not ask me what is credit risk. After discussing so much, please do not ask me what is credit risk. We have discussed it earlier. Credit risk is the risk wherein the borrower doesn't repay the loans or the amount they have borrowed, as a result of which banks might incur losses. So credit risk was identified, and because of credit risk, the banks would be incurring losses. Hence, we introduce the concept of risk-weighted assets and use the risk-weighted assets to calculate capital adequacy ratio, CAR, or credit to risk-weighted assets ratio. Right? So CAR or CRAR of 8% was actually announced. So adopted by India back in 1999. But over a period of time, certain other risks were identified, certain crises were experienced around the world. So another round of regulation was announced, which is called as Basel II guidelines. It was announced in 2004. India has implemented Basel II. We're in the process of implementing Basel III now. Now, rather than only one risk, we have introduced two more type of risk. We have extended the type of risk that the bank will face. One is credit risk, second one is a market risk, third one is operational. Some of the books will also refer to this as systemic risk. One is credit, second one is operational, third one is systemic risk. What are these? We have discussed earlier. Now, please tell me, is it okay if I generalize and say a bank can incur losses because of first, second, or third, or any combination of 1, 2, and 3? Let me know. I'll put a statement now. A bank can incur loss because of either only 1, only 2, or only 3, or a combination of all the 3. It can be because of 1 and 2 also. It can be because of 1 and 3 also. It can be because of 2 and 3 also, or it can be because of 1, 2, and 3 as well. So bank might incur a loss because of these 3 types of risk. Now, how these risk will be addressed? How do we reduce, minimize the risk? How do we absorb the losses? First pillar, First pillar, and that is basically to take care of these three types of risk. First pillar, capital adequacy ratio. We have discussed what is capital adequacy ratio earlier. Capital adequacy ratio simply refers to the minimum amount of capital. I repeat, the minimum amount of capital that the banks must maintain in order to absorb losses. Now, please tell me, is it okay if I say a bank with a higher capital adequacy ratio is better placed to absorb losses? I'll repeat the statement. Anybody has a problem, let me know. A bank with higher capital adequacy ratio, let's say 14%, 15%, 16% capital adequacy ratio, can I simply say this bank is better placed to absorb losses? Right? That is, let's say bank 1 has a capital adequacy ratio of 7%, bank 2 has a capital adequacy ratio of 13%, which means if both of these banks have risk weighted assets worth 100 rupee, bank 1 has 7 rupee capital to absorb losses and bank 2 has 13 rupee to absorb losses. So a bank with a higher capital adequacy ratio is always better placed to absorb losses. And in the same way, is it okay if I say if the capital adequacy ratio of a bank is falling, it is a cause of concern? If the capital adequacy ratio or CRAR of a bank is falling, not following, is falling, is declining, is it not a cause of concern for a bank? Is it not a cause of concern for Reserve Bank of India? Of course, yes, it's a cause of concern. Is it okay? Can I go forward now? So first one is capital adequacy ratio. Capital adequacy ratio 8%. In fact, in India, please remember this. In fact, in case of India, it's not 8%, it is 9%. Generally, it is 9% in India because RBI says, although Basel guidelines say 8%, I will keep more than 8%, I'll keep 9%. Right? So RBI has the right. RBI has every right. It has powers to change these numbers, just like the Federal Reserve or any other bank in the world. So in case of India, it is generally 9%. For scheduled commercial banks, right, it is 12%. For payment banks, it is 15%, etc. So from one class to another class, the numbers generally vary like this. Can we go forward? Anybody has a problem? Supervisory review. What do you mean by supervisory review? Every bank knows that they're facing systemic risk, they're facing market risk, they're facing credit risk. They know that. So new systems, new processes, new technology should be introduced so that these risks will be minimized. Is it okay? I'll repeat it again. What is supervisor review? Every bank knows that they're facing a credit risk, market risk, as well as operational risk. So new type of systems, new processes, new, let's say, framework should be implemented by these banks so that we will manage and reduce all the risk. Right? That is called as supervisory review. Third one, market discipline. Market discipline. What is the meaning of market discipline? Every bank should keep on reporting the data to RBI. That is how much tier 1 bonds you have. Please report to RBI. How much is your risk weighted assets? Report to RBI. How much loans you are giving overall? Report to RBI. How much additional tier 1 bonds you are issuing? How much tier 2 bonds you are issuing? How much share money you are collecting? All this information, every bank should keep on reporting to the regulator, that is Reserve Bank of India. That is called as market discipline. Is it okay? Can I go forward now? Can I go forward? Basel 2 is an expansion. It is an expansion of Basel 1. Earlier we covered only one risk. Now we are covering 3 risks. To address the issue of all the 3 risks, we have 3 pillar approach. One, maintain capital adequacy ratio. Second one, introduce new systems and new technology, new processes so that you will minimize the risk. And the third one, whatever you do in terms of, let's say, your regulatory, in terms of the application of regulations, such as a capital, such as a share capital, such as a tier 1 capital, tier 2 capital, risk weighted assets, all these information you report to the regulator, that is the Reserve Bank of India. That is market discipline. Can we go forward? This is Basel 2 guideline. Let me go to Basel 3. We are in the process of implementing Basel 3 now. We are in the process of implementing Basel 3. What is this Basel 3? It was introduced in 2010. Again, the reason is very simple. In 2008, in the year 2008, the global market experienced a crisis, very famously referred to as global financial crisis. Back in the year 2008, there was a crash in the international market, started in USA, but affected the global market. So because of this crisis, it was seen that many of the banks were also affected. So to improve upon the regulatory powers which are given to central banks, to improve upon the, let's say, supervision that the banks have, third round of regulations, third framework was actually announced. Under Basel 3 guidelines, what are the important provisions? Important provisions. First one, capital adequacy ratio of 9% as usual. Again, please understand, if you look at these, it is an extension of three pillar approach that we have followed in the Basel 2. Extension, expand the three pillar approach now. So first one is capital adequacy ratio. But within the capital adequacy, within the total capital, now please do let me know which one would be more or which one should be more according to you. Out of your total capital, would you prefer to have more of tier 1 capital or more of tier 2 capital? Let me see how you are able to ascertain or understand these concepts. Imagine you have capital, total capital. Which one should be more? Should the tier 1 be more or tier 2 should it be more? Right, sir? Some of you are saying, sir, capital should be more. My dear, capital is there, but I'm asking within the capital that you have, should the tier 1 be higher or tier 2 be higher? Tier 1 should be higher. Tier 1 should be higher. It should make perfect sense to you. Some of you are answering tier 2 now. Why, my dear? Between these two, I'm asking. I'm not asking total capital. Total capital should be higher. I do understand. But between tier 1 and tier 2, which one would you prefer? More tier 1. Because it can absorb the losses much sooner. It can absorb losses much easily compared to tier 2 capital. Okay, so tier 1 should be higher. That is the reason. Look at the second parameter now. Please look at the second parameter. Tier 1 capital at 7% of risk weighted assets. Whatever you are having, let's say you are having 9%. Out of 9%, 7%, at least 7% should be tier 1 capital. More reliance on tier 1 capital. Okay. Third, capital conservation buffer, CCB. Capital conservation buffer. Now, what do you mean by buffer here? Please understand, buffer means extra. Buffer generally means extra, additional. Extra or additional. Now, generally, the RBI, in case of India, RBI, at the international level, Basel guidelines. And the argument is that you have certain capital. This capital is generally sufficient to absorb the losses during normal times. I'll repeat the statement. You have certain amount of capital. This is sufficient to absorb the losses during normal times. But what if there is a crisis? What if there is an emergency? What if suddenly, because of external or internal events, your losses will start expanding? So during these emergency situations, the capital that you have may not be sufficient. That is the reason, in addition to the normal capital that you're having, in addition to the capital that you're having, maintain extra capital, maintain buffer, additional capital. That is called as capital conservation buffer. Now, if you're having a doubt regarding this even now, please do let me know. All those who are carrying a wallet or purse, will you not keep certain amount of money hidden within one of the compartments of the purse? Let me know. Think of it and do let me know. All of you are carrying a wallet, I know that. But you will take one 500 rupee note or 100 rupee note, fold it in a compact manner, and you will try to hide it, Basically a secrecy, Try to hide it in one of the compartments. Why? What is the argument? If I ask you why you do that, will you not tell me, sir, if there is an emergency, I will take it out of this particular compartment. Does it make sense to you? I also do that. Some of you are asking, sir, yes, how do you know it? My dear, I also do it. I also do it. Most of us do it. Or else I'll give you one more prime example. One more prime example. Have you seen your mother? What your mother generally does, including mine, by the way, even my spouse. If they have certain amount of cash, if they have certain amount of cash, they will take part of it and they will fold it, or they will put it in a right bag, or they will make it compact manner, put it in one of the saris, right, put it in, let's say, a sugar box, put it in a dal box under, right, exactly below at the lower part of the box. Why? What is the reason, do you think? What is the reason? The reason is simple. They'll say, in case of emergency, if there is a sudden emergency in the home, right, there might be a situation where we don't have cash. At that point of time, they will take it out. They will take it out. They'll simply take it out and show you, see, right? That is the reason I used to store, right? Without you knowing it, I used to store it. Okay, anyways. So now, at least now all of you know the concept of buffer. Please do let me know. At least now you know the concept of buffer now, addition, right? Addition, keep something extra. During normal times, you have certain capital. That is sufficient. But if there is emergency, you need extra capital to absorb losses. That is called as capital conservation buffer. So capital adequacy ratio is 9%. Capital conservation buffer is 2.5%. Can I say total capital requirement is 11.5%? Let me know. Total capital requirements under Basel III is 11.5%. So including buffer, the capital requirements will be pulled up to 11.5%. Liquidity coverage ratio, LCR, liquidity coverage ratio. Now, what is this concept of liquidity coverage ratio? Under Basel III, the guidelines say that every bank should estimate how much will be the cash outflow, how much will be the money outflow in the next 30 days, and equivalent to that, 100% of it, they should maintain in the form of certain assets which they can simply sell and generate cash. I'll repeat it again. Listen to me very carefully. What is this concept of liquidity coverage ratio? Every bank must estimate. Nobody can know how much money will go out exactly to the rupee in the next 1 month. Estimate how much money will flow outside the bank, out of the bank in the next 30 days. And whatever the amount is, 100% of it, the bank must maintain in the form of certain liquid assets. High quality liquid assets. High quality liquid assets simply means which you can quickly convert into cash, which you can quickly convert into money. That is called as a liquidity coverage ratio. Imagine there is a bank. The bank estimates festival season is there, and during the festival season we are expecting higher outflow of money, 200 crore rupee. Then in the next 30 days, or for the next 30 days, you should keep 100% of this. 100%, that is 200 crore rupee, in the form of, let's say, high quality liquid assets. And many of you ask me, sir, what do you mean by high quality liquid assets here? Can I say, right, look at these examples and let me know. Treasury bills, 5-year government bonds, 10-year government bonds, or in the form of cash itself. All of you okay with this? And why this regulation is there? Why is this, right, let's say guideline is there? Let's say a bank is there, it has not estimated correctly, or it has not done any estimation at all. If all the customers, or let's say a lot of customers, will go to the bank and start withdrawing money, don't you think the money that is there, cash that is there with the bank, they will run out of it very soon? Think of it and do let me know. The cash that is there with the bank, they will run out of it very soon. And in the market, people will realize, customers will realize, array, the bank doesn't have money. They don't know that the bank has issued loans. They don't know that they will collect it later. But in the market, customers feel the bank doesn't have money. And if the bank doesn't have money, they will not pay us back. So what all the customers will start doing is all of them will go to the bank and start withdrawing money. Right? That situation is called as bank run. Bank run, where customers are continuously withdrawing money, bank runs out of cash. Now, please tell me, simple example, please tell me, if the bank is having, let's say, 100 crore worth of G securities, if there is such a situation, can the bank sell the G securities, raise money, allow for outflow of the money from the bank? Possible? Correct? Anybody has a problem with this? Right? If the bank has G securities, you can simply sell them in the market, get the money, allow for outflow of money from the bank without any issues, without causing any problems to anybody. Possible. That is the reason we have concept of liquidity coverage ratio. So 100% of next 30 days estimate, 100% will have to be kept in the form of high quality liquid assets. The bank can simply sell them, raise money or get the money and allow for outflow. That is called as a liquidity coverage ratio. Done? Can we go forward? Can we go forward? Sir, how withdrawals can be estimated? My dear, please tell me, if you're a bank, don't you know, based on your past experiences, etc., don't you know some amount of estimated outflow that you will experience in the next 1 month? Think of it. Right? I'll give a very simple example. How much FDs are going to mature in the next 1 month? Will you get the data regarding this? Let me think of it. How many bonds that you have issued, which are going to mature in the next 1 month? Can you come to know about this data? Yes. How much deposits generally people withdraw? Again, please understand. Again, I'm saying estimate. Understand the term estimate. Estimate doesn't mean exact number. Estimate means a roundabout number. You think this much money will be going out. Estimates are done. Because even if you don't have any estimate, that will create a bigger issue. At least estimates will provide a certain cushion. Okay. So that is the importance of the Basel 1, Basel 2 as well as Basel 3 guidelines. Can we go forward? Done. Let me go to the next concept now. Non-performing assets. NPA. Non-performing asset. NPA. Listen carefully. Current affairs concept. Important. So far UPSC has not touched this. Now what is this NPA? Non-performing asset. Point number 1. Let me know anybody has a problem with this. Asset is nothing but the loans or advances issued by the bank. Assets are nothing but the loans or advances issued by the bank because they will get returns to the bank. Now, whenever the loans are issued or advances are issued and the repayment doesn't happen, I'll repeat, the bank has issued loans, the borrower will stop making a repayment. Such assets are called as non-performing assets. Technically, I'll give a technical definition now. If the borrower has not repaid either interest or the principal or a combination, either the interest or principal or the combination for 90 days from the due date, it is called as a non-performing asset. Is it okay? Can I go to the next point? I'll repeat it again. Listen carefully. If the borrower doesn't pay back interest, principal or a combination for 90 days from the due date, then such an asset is called as non-performing asset. For example, let's say I've taken a loan from you. I'm supposed to make a payment on 5th of January. I'm supposed to make a payment on the 5th of January. That was the last date or due date. I will not repay. So now you will wait for 90 days. I repeat, you will wait for 90 days. After 90 days is over from the due date, you will classify this loan as a non-performing asset. You will classify this loan as a non-performing asset. But for 90 days, it will be classified as a special mention account. SMA. For 90 days, it will be classified as special mention account. SMA 0, SMA 1, and SMA 2. If the borrower customer doesn't repay for 30 days, up to 30 days from the due date, it is called as SMA 0. From 31st day to 60th day from the due date, SMA 1. 61st day to 90 days from the due date, it is called as SMA 2. And after 90 days is over, this account, that is this loan, will be classified as non-performing asset, NPA, non-performing asset. And even in case of non-performing asset, imagine I've taken the loan. Understand this carefully. Some of the students will get confused. Listen. I've taken the loan on 5th of January 2024. Let's say 2024. I did not repay. So you will wait for 90 days. And again, don't start calculating and say calendar wise, etc., etc. Let's say hypothetically, January, February, and March. So can I simply say 5th of April, assuming 30 days in all the months. Assume 30 days in all the months. So can I simply say 5th of April, you will classify this account as NPA? Please do let me know. 5th of April 2024, you will classify this account as non-performing asset. Okay. Now, after you are classifying this account as a non-performing asset on 5th of April 2024, for the next 1 year, for the next 12 months, right, up to 12 months, that will be 5th of April 2025, this will be referred to as substandard NPA. From the 5th of April 2024 to 5th of April 2025 will be classified as substandard NPA up to 12 months. And after 12 months, this loan will be classified as doubtful NPA. Right? And for how many years? For how many years it will be classified as a doubtful NPA? Yeah, doubtful NPA. Substandard will be for 1 year. And after this 1 year, for the next 3 years, after 1 year, for the next 3 years will be classified as a doubtful. And after 1 plus 3, it will be classified as loss-making NPA. All of you okay with the classification? Right? If you borrow and repay, I'll call this as a standard asset. If you do not repay up to 90 days, I'll call this as a special mention account. And after 90 days, I'll call this as a non-performing asset. And within non-performing asset also, once the account is classified, once the loan is classified as an NPA, for the first 12 months, I'll call this as a substandard NPA. After 1 year, for the next 3 years, I'll call this as a doubtful NPA. And after 1 and 3 years is over, next I'll classify this as a loss-making NPA. Right? This is basically how the classification is done in the banking sector. Okay? This is how classification is done in the banking sector. Now, please do let me know. Right? Many of you are asking why such classification, etc., etc. Right? Don't you think if your account, that is you're a bank, one of the loans that you have given to me, rather than standard, will become a special mention account. And from special mention account, it becomes, right, let's say NPA. Within NPA, it will become a doubtful NPA. Does it not mean very soon, right, you will have to simply start making provisions to absorb these losses that you're going to incur? Let me know why this kind of a classification, etc. Right? Now, please tell me, should you be more concerned about a loss-making NPA? Should you be concerned more about a loss-making NPA, or should you be concerned about a standard asset? Standard asset, you are getting money. But loss-making NPA means now you'll have to start making provisions in order to absorb losses. Right? That is the reason this kind of a classification has to be done. All the NPAs are not same. In simple terms, all the NPAs are not the same. Now you'll have to start making provision. Provision means start allocating money which you will use to absorb losses that you are going to incur because of the loans. Okay, done. Now, why NPAs are very high? Why NPAs are very high in India? What are the reasons? What are the reasons? Let's go one by one. First one, there is a lower demand in the domestic market as well as right international market. Right, again, not very recently, but even before that also. Please do tell me, during pandemic, did you not come across declining demand in domestic market as well as the international market? And again, not just pandemic, even before pandemic also, 2008 global financial crisis. During that also, demand in domestic market as well as international market took a hit. Right, so there is a declining demand in the domestic market as well as the international market. And what is the impact of it? Let me explain. Listen to me carefully. Let me explain. Imagine here is a bank. Imagine here is a bank. Step one, they will collect money from depositors. Correct? They will collect money from the depositors. And step two, they will give loans. They will give loans to borrowers. Step three, the borrowers will repay the loan. The borrowers will repay. And step four, bank will allow, right? Bank will earn money, and because bank has, they will return, right, the funds which they have borrowed from the depositor. Generally, this is a sequence. All of you okay? This is a sequence. Collect, lend, again collect back, and allow for deposits to be withdrawn. Now, what has happened because of the domestic market demand as well as international market? Imagine this borrower is a company. Imagine this borrower is a company. So now, company has taken the loan. It has produced goods and services. It is unable to sell and generate revenues. It is unable to sell. Either the sales has come down, or right, the sales has declined by a small percentage, large percentage, lockdown has been imposed, there's a crisis in the international market, etc. Whatever the reason is, can I say the company might start incurring losses? And if the company will start incurring losses, automatically the repayment to the bank would be affected. Automatically the repayment that it will do to the bank will be affected. So the NPAs in the banking sector, will start rising up. In fact, remember, there is one technical statement regarding this. They will call this issue as twin balance sheet problem. Twin balance sheet problem. Listen to me very carefully now. If the bank will issue a loan to a company, company is unable to sell and generate revenue as incurring losses, it will not repay the loan to the bank. Can I say balance sheet of the bank as well as a balance sheet of the company, both are under pressure? Think of it. Let me know. Is it okay or not okay? I'll repeat it again. Right? You're a bank. I've taken the loan from you. I'm supposed to sell, earn money, and repay the loan. But because of lower demand, I'm incurring losses. I will not repay the loan to you. So can I simply say my balance sheet as well as your balance sheet, both are under pressure? In my balance sheet, your loan is a liability for me. I'm supposed to repay. I'm not able to repay. In your balance sheet, loan is an asset for you. Bank, loan is an asset for you. You're not able to generate revenue. So your balance sheet, my balance sheet, both are under pressure. Can I call this as a twin balance sheet problem? Last year it was used in one of the monetary policy reviews of RBI. Last year RBI said, right, banking sector in India currently, that is in 2022 and 23, the pressures of twin balance sheet problem has reduced. It has come down. We are not facing twin balance sheet problem, RBI said. So that is a basic idea. So first point and second point, global demand as well as slowing domestic market, both can contribute to higher NPAs. Next one, willful defaulters are also increasing. Willful defaulters are also increasing. Now, what do you mean by a willful default? Willful means purposely. Willful is nothing but purposely or intent, with intent. Now, what is this willful defaulters? Willful defaulter is a borrower who has sufficient financial capacity to repay the loan, but purposely will default on the repayment. I'll repeat the statement here. Listen to me very carefully. How does RBI classify as a willful defaulter? A borrower who has sufficient capacity to repay. They have sufficient capacity, that they have the power to repay the loan, but purposely, with intent, they will default on the repayment. Such borrowers are called as willful defaulters. Such borrowers are referred to as willful defaulters. So the number of willful defaulters in India have increased. They have increased. And when willful defaulter number increases, automatically NPAs will also start increasing. Next, DRT, inefficient functioning of DRT. What is the DRT? DRT simply means Debt Recovery Tribunal. Debt Recovery Tribunal, DRT. Now, what is the problem with the functioning of DRT here? Listen now. Whenever retail borrowers, retail means individual borrowers. Whenever individual borrowers will take a loan from a bank and they will default on the payment. I'll repeat the statement here. Whenever individual borrowers, such as you, such as me, we are called as retail borrowers. Whenever retail borrowers will take a loan from a bank and will default on the payment, bank will take us to an authority called as Debt Recovery Tribunal. They will file a complaint against me at a Debt Recovery Tribunal. And in the Debt Recovery Tribunal, right, proceedings will be conducted and the DRT will issue an order how to recover the money, etc. Now, please tell me, I'll ask a very simple question. Please tell me, if number of cases filed, if number of applications filed in the DRT increase exponentially, that is the number of applications filed are very, very high, but the number of judges to hear the cases are, right, comparatively lesser, don't you think it will take a very long time period for the judges to clear all these cases? Does it make sense to you or not? Just like judiciary, right? The number of benches we have, number of judges we have, the infrastructure we have is not sufficient. Whereas the number of applications filed are increasing at a very, very fast pace, right? Applications are increasing, sufficient infrastructure is not there. So time taken to resolve these applications, take up these applications will be very, very high. So that is also the reason why NPAs are continuously increasing. NPAs are continuously rising in India. And finally, governance issues. Governance issues. Right? For example, what if judiciary issues an order stopping an infrastructure project? What if one of the ministries of government of India will issue an order asking a project to be stalled? Sir, how? Why do they do that, etc.? In multiple situations, I'm pretty sure I've come across it, but without realizing it. In multiple cases, the infrastructure project has started, the development has started, but the judiciary, let's say Supreme Court of India or a High Court of a particular state, will issue an order stopping the project. They will say that there are certain environmental concerns, right? There are certain issues regarding where the project is being developed. So do not develop the project, stop it right now. And in many cases, have you not seen state governments, where one government issued an order for one company to develop a project, the government changes, the political party is different now, government changes, the new government will find an issue with earlier order, earlier tender and say corruption was there, stop the project. Have you come across these examples or not? So in many of these projects where governmental changes or orders of the government changes, right, or let's say judicial intervention, the projects have been stopped in between. Projects have started, but they have been stopped. And when the projects are stopped, let's say I've taken a loan I want to construct a project, but because of change in the government, now I'm not allowed to develop the project. They have stopped the order, which means I've taken the loan. Without completing the project, I will not be able to repay the loan. I hope it makes sense to you. Without completing this project, I will not repay the loan. So what will I do? I will stop making a repayment. I will not make any kind of repayments. That project will be classified as non-performing asset. So even in case of governance issues, that has contributed to a lot of accumulation of non-performing assets. Done. So these are some of the reasons why NPAs are high in India. So tomorrow we'll continue with this. If NPAs are higher, what is the problem? And tomorrow we'll discuss questions. Tomorrow we'll take up questions. A lot of questions have come from banking last 2 to 3 years, right? We will discuss the questions again in banking. Predominantly the questions have come in the prelims. Mains questions, whatever the reason, they have not been asked by UPC so far in the banking sector. Okay, done. So any issue, any doubts that you people have, please do let me know. I'll address it. Then we can stop the discussion. So recent Telangana Kaleshwaram project, yes. Many cases, again, I don't want to get into respective projects here. In many of the infrastructure projects, just the change in the government, forget about change in the government, change in the minister has led to stoppage of infrastructure projects. Okay. Sir, example part not understood for car. I'm saying, let's say, hypothetically, you have 100 rupee risk weighted assets. You have 100 rupee risk weighted assets. And if the car number, if the CRAR mandate for you is 9%, it simply means for every 100 rupee risk weighted assets that you have, you should maintain minimum capital of 9 rupee. Okay. Sir, why would someone default willfully? My dear, can I give you certain examples? Right, Mr. Vijay Mallya. Right, have you heard of him? Mr. Vijay Mallya. Again, I can give you n number of examples. Not needed. Mr. Vijay Mallya has been classified as a willful defaulter. Now, please tell me, has he willfully defaulted on the repayment of loans in India or not? Of course, yes. Okay. Substandard also includes 90 days. My dear, before 90 days, we'll classify it as a special mention account. Right, again, I'm sorry, 90 days or before 90 days, right, a special mention account. Once I cross that 90-day barrier, after 90 days, I'll classify it as a substandard. Okay, what is the difference between credit risk and NPA? Credit risk is the risk that you're facing. If the borrower doesn't repay, it is a risk that you're facing. NPA simply means the borrower doesn't repay, and after 90 days, you classify it as a non-performing asset. Credit risk will manifest. I'll repeat the statement. Credit risk, when it will manifest, it will become basically lead to NPA, and NPAs might lead to losses for the banks. What is sterilization done by RBI? I'll take it up later when I take up international trade. I'll explain it. Don't worry. Right? Why RBI conducts sterilization? I'll explain it later. Doubtful NPA is 3 years after 12 months. Yes. Substandard 12 months. 1 year. After 1 year. Listen to me. After 1 year for the next 3 years. That is doubtful. Okay. Okay, any other doubts? Can LCR be used to save from bank run? Generally, that is the argument. The bank should have sufficient liquidity. Whenever withdrawals will happen, the bank should have sufficient liquidity to allow for outflow of money. Okay, done then. Let me stop the discussion today here. We'll continue the discussion tomorrow. Okay, we'll continue the discussion tomorrow from this particular slide. What is the impact? If NPAs are higher, what is the impact? We'll start from this slide. Okay, take care. Please read the newspaper articles. Right, keep on revising, keep on updating information. So that's it from my side. See you tomorrow. Have a good day.